Okay, if y'all could grab your seats, we can get started again. I think we had a great day of discussions yesterday, and this morning, my boss Lori is going to make some more formal, extensive opening remarks. Lori.
Good morning. Happy Halloween. Mark talked about the swag you could buy at the coffee shop, but there's also Halloween candy out there too, so hopefully that gets you to the coffee shop. It's great to see all of you joining us again today. I thought yesterday's discussion was so enriching, and I'm really excited to build upon the themes that we talked about yesterday. I just want to also thank all the panelists, and particularly Daryl Duffy for dinner remarks for those of you who were able to join us last night at dinner, which I thought were fantastic. So thank you. I think as all of you in this room know, the FOMC reduced interest rates earlier this week and announced that it would end the runoff of the Fed's asset holdings as of December 1st. So in my remarks this morning, I thought I would touch on monetary policy and then turn to the topic of the conference and describe how the Fed's balance sheet fosters a safe and efficient liquidity environment for the US banking system. But before I do that, let me give the same disclaimer as yesterday and say that these are my views and not necessarily those of my FOMC colleagues, but I think unanimously we would all say Happy Halloween. So I'll start with monetary policy. At this week's FOMC meeting, I would have preferred to hold interest rates steady. Congress gave the FOMC a dual mandate to pursue maximum employment and stable prices. The labor market remains balanced and cooling slowly. Inflation remains too high, taxing the budgets of businesses and families, and appears likely to exceed the FOMC's 2% target for too much longer. So I didn't see this economic outlook as calling for cutting rates. While the government shutdown has reduced the availability of national statistics, a wide range of alternative data continue to provide visibility into the state of the economy. Those sources include private sector indicators, continuing administrative data such as the unemployment claims, regional surveys run by many of the Federal Reserve banks, and the many conversations that my colleagues and I have with business and community contacts every week, including at events like yesterday and today. The labor market remains roughly balanced at 4.3%. The latest reading on the unemployment rate was up only slightly over the past year on net. Payroll job gains fell markedly in 2025, but slow job gains don't necessarily mean there's more slack in the labor market. Labor supply has fallen at the same time as demand, particularly due to changes in immigration policy and labor force participation. In consequence, despite the drop in job growth, we're not seeing a rapidly widening gap between the number of jobs available and the number of people who want work. My staff estimates that break-even payroll growth, that is the number of net new jobs needed to hold unemployment steady, has fallen to around 30,000 jobs per month. The BLS has delayed its September employment report. However, private sector data suggests September payroll growth remained near the level that would keep the market in rough balance. Likewise, layoffs and unemployment claims have stayed low, although I'm mindful of the recent layoff announcements by some large employers. Resilient consumer and business spending continues to support employment. Consumer spending growth has slowed from last year, but only to a pace that equals or slightly exceeds longer run trend. Stock market gains are fueling wealthier households' demand. Large companies are investing enthusiastically in AI and data centers. And the picture for lower income families and smaller businesses is certainly softer than the aggregate, but remains stable. The Dallas Fed produces a weekly economic index on our website. It combines 10 daily and weekly data series to deliver a rapid signal of the state of the economy. It is averaging 2.4%, and that's consistent with strong GDP growth in the third quarter. The risks to the labor market do lie mainly to the downside. In this low hiring environment, the job market could have difficulty absorbing any significant pickup in layoffs from the current low level. Buoyant asset valuations can sometimes snap back without much warning. which might take the wind out of consumer spending. And the federal government shutdown will pose greater risks to economic activity the longer that it continues. But these are all risks the FOMC will be able to closely monitor and address promptly if there's evidence they're becoming more likely to materialize. So turning to the price stability side of the mandate, inflation is still too high and too slow to return to target. We target a 2% inflation rate as measured by the annual change in the price index for personal consumption expenditures, or PCE. And inflation by that measure exceeded the target in each of the past 4 years. It's on track to do so again this year. The index rose 1.8% just in the first 8 months of the year, and forecasters expect it to end the year up about 2.9%. While inflation has come down significantly from the post-pandemic peak, it's still not convincingly headed all the way back to 2%. The Blue Chip Economic Indicator surveys dozens of private sector forecasters about their economic outlook. The Blue Chip consensus outlook is for 2.6% PCE inflation in 2026 and around 2.4% in 2027, followed by fluctuations between 2.1 and 2.2% all the way out to at least 2031, never all the way back to target. The FOMC's 2% inflation target is a serious commitment. We've reaffirmed it repeatedly, most recently in the statement on longer run goals and monetary policy strategy that we issued in August. Our obligation to the public is to deliver on this commitment. To be sure, inflation persistently running several tenths above the target is not the emergency that inflation persistently several percentage points above the target would be, and we have an equally serious obligation to pursue maximum employment. The FOMC's long-run strategy calls for a balanced approach to our two objectives. I carefully weigh the potential labor market costs of measures to reduce inflation, but labor demand and supply remain in balance. The FOMC already mitigated downside risks by cutting rates at its previous meeting in September. The remaining risks to employment are ones we can monitor closely and respond to if they're becoming more likely to materialize, not ones that currently warrant further preemptive action. For those reasons, I didn't see a need to cut rates at this week's meeting, and I'd find it difficult to support another cut in December unless there's clear evidence that inflation will fall faster than expected or that the labor market will cool more rapidly. So at our meeting earlier this week, the FOMC also decided to stop reducing the Fed's asset holdings as of December 1, ending a phase of balance sheet normalization that began in mid-2022. Now, in contrast to the action on interest rates, the decision to end asset runoff was one I supported. Money market conditions indicate the Fed's balance sheet is now much closer to a normal size, following the expansion in response to the distresses during the pandemic and the subsequent runoff. So more than just a return to normal, the reduction in the balance sheet forms part of how the Fed promotes safe and efficient liquidity for our nation's banks. Of course, the primary responsibility for banks' funding and liquidity risk management lies with bankers. Still, the Fed's balance sheet underpins some aspects of bankers' decisions, and that's what I'd like to talk more about this morning. The Fed's single largest liability, nearly half of our balance sheet, is bank reserves. Dollar reserves are the safest and most liquid asset in the world. Reserves are assets to the banks that hold them, and their corresponding liabilities for the Fed. A dollar of reserves is always worth exactly $1. No more, no less, always $1. Reserves are also the only asset a bank can use immediately to meet a withdrawal or send a payment. If you're holding a loan to one of your customers, a corporate bond, or even a treasury bill, you have to sell that asset or borrow against it to get money before you can make a payment. Reserves, by contrast, already are money. You can make a payment with reserves right away. You never have to monetize them first. In normal times, it's straightforward for healthy banks to borrow against assets to get cash. But when markets come under stress or when a bank needs to quickly obtain unusual amounts of liquidity, monetizing assets can be more difficult. Reserves help a bank manage its liquidity risk and serve customers efficiently through thick and thin. As authorized by Congress, the Fed pays interest on banks' reserves holdings. And these interest payments have no material cost to taxpayers because over time, the Fed covers them out of interest earnings on its assets. However, interest on reserves plays a crucial role in the efficiency and safety of the banking system. When the interest rate on reserve balances, or IORB, is close to interest rates on other money market instruments, it doesn't cost banks anything to hold reserves to meet those liquidity needs that they have. If reserves paid less than market rates, on the other hand, or no interest at all, each dollar of reserve holdings would cost a bank the difference between market rates and the interest on reserve balances. Banks would have a strong incentive to avoid holding them. Now, the Fed didn't pay interest on reserves until 2008, and the old system, in my view, was inefficient and risky. Because reserves were costly to hold, banks tried to hold as few as possible of them. And with few reserves on hand, banks often throttled outgoing payments until they received incoming money each day. And Daryl spoke about this with us last night at dinner. They also arranged their business models to reduce regulatory reserve requirements, and then they tried to minimize their actual reserve holdings by lending anything above the regulatory minimums to other banks. So considering it doesn't cost the Fed to provide reserves, all those gymnastics represented wasted effort for the economy. And that's the best case. If costly liquidity held banks back from providing the services their customers would have valued, the old system of scarce reserves put a brake on economic growth for no good reason. Moreover, if banks were taking unnecessary liquidity risk because they avoided holding the safest, most liquid assets in existence, the financial system was more vulnerable to shocks, again, for no good reason. Since 2008, the Fed has met banks' demand for reserves, with interest on reserves close to market rates. In 2019, the FOMC decided to continue implementing monetary policy in the long run in this framework that we call ample reserves. This is simply a better approach, better for banks, better for the households and businesses that are their customers, and better for the US economy broadly. And I'm proud the Fed adopted it, and I'm committed to continuing it. Now, you might ask, if reserves are so great, why did the FOMC run off asset holdings from 2022 to 2025, and consequently also reduce reserve supply? Like I used to tell my kids when we went to the ice cream shop, or perhaps better today when we went trick-or-treating, it's possible to have too much of a good thing. The FOMC acquired large quantities of assets during the pandemic to support smooth market functioning and provide economic stimulus. Those purchases helped keep the public health crisis from turning into a financial crisis or recession. But among their side effects was that the purchases made reserves not just ample, but abundant or superabundant, more plentiful, that is, than the quantity banks wanted to hold, with market rates near interest on reserve balances. Supplying too many reserves is just as inefficient as supplying too few reserves. To best serve the economy in normal times, the Fed needs to strike a balance and supply an efficient quantity of reserves, neither too many nor too few. There are many indicators of reserve ampleness, but the most significant one to me is the position of money market rates relative to interest on reserve balances. In an efficient system, market rates should be close to, but perhaps slightly below interest on reserves on average over time. On average is the key of that sentence. Market rates can fluctuate from day to day, and bringing the average level close to IORB also requires some tolerance for modest, temporary moves above interest on reserve balances. Those fluctuations should help in returning the Fed's balance sheet to an efficient size. Many banks have adapted their business models to an environment with more than ample reserves and market rates consistently below interest on reserves. These adaptations likely increase the aggregate demand for reserves compared with the pre-pandemic level. There's a ratchet effect. To meet banks' reserve demand in the short run, the Fed now must supply more reserves than it would have previously. So since late summer, market rates have risen significantly relative to IORB. The rise in market rates relative to IORB will likely make many banks want to cut back on reserve holdings. And there's only so much a bank can do, though, to reduce its reserve needs from one day or week to the next. As we heard in the panel yesterday, it takes time to shed unwanted deposits or to adjust the composition of asset and liabilities, so the bank needs less immediate liquidity. By sustaining a period of money market rates averaging close to IORB, including some modest temporary swings higher, the FOMC can give banks the incentive to make longer-term adjustments. In turn, those adjustments will undo the ratchet effect, allowing the FOMC to meet banks' long-run demand for reserves, rather than temporarily higher short-run demand. So this will let the Fed operate with a smaller, more efficient balance sheet over time while continuing to foster safe and efficient liquidity for the banking system as a whole. However, it's important to note to not take those incentives too far. Rates averaging above IORB in a sustained way would be inefficient. The FOMC has followed a two-part strategy to help banks adapt and bring the financial system to reserve levels that will be ample in the long run. So first, we reduced reserve supply gradually. After beginning asset runoff in 2022, we twice slowed the pace of runoff to produce a gentler glide path for aggregate reserves. The gradual decline in reserves gave banks more time to change their business models and their own balance sheets during the transition. Second, we established strong tools to put a ceiling on money market rates and to provide additional liquidity if necessary. The discount window is available every business day to healthy banks, with primary credit offered against a wide range of collateral at an interest rate equal to the top of the Fed funds target range. We continue to work to make the window more usable. We're taking on board the public feedback we received from a formal request for information last year, and we'll be taking on board the feedback we heard from all of you yesterday. What we hear is that the industry wants transparency about the amount a bank can borrow, prompt approval of loans, and seamless movement of collateral. We hear that feedback. We're working to modernize our operations. For example, our discount window direct tool now lets bankers request loans online, and we're working toward allowing firms to manage collateral there as well. Yesterday's panel addressed the interactions between the discount window and the FHLBs, and we are collaborating with the FHLBs to streamline those connections. The Fed standing repo facility also offers funding to eligible counterparties at the top of the target range against Treasury and agency MBS. I was disappointed to see rates on a large share of tri-party repo transactions exceed the standing repo facility rate at times this week. I anticipate that primary dealers will use the facility to obtain repo funding when it's economical to do so. Drawing on the standing repo facility when the rate is economical is a sound way for a primary dealer to serve the market. With rates averaging higher than they were just a few months ago, the likelihood of the standing repo facility rate becoming economical on some days is higher, and dealers may now need to step up that readiness to access the SRF in response to rate moves. But the way the Fed implements the standing repo facility operations can also affect counterparties' willingness to use it. This year, the open market trading desk at the New York Fed added morning settlement standing repo facility operations to provide funding earlier in the day. Counterparties have responded positively to that enhancement, and in my view, another important enhancement is central clearing. That would further strengthen the facility's effectiveness. Effective ceiling tools will allow the FOMC to permit modest interest rate fluctuations without risking large upward spikes in rates. So in recent months, money market rates have moved up towards and sometimes above interest on reserve balances. After averaging 8 or 9 basis points below IORB in the first 8 months of this year, the tri-party general collateral rate averaged slightly above interest on reserves in September and in October. TGCR is a rate on overnight repo agreements collateralized by Treasury securities. It's a safe rate in a liquid and competitive market, and I view it as the cleanest single measure of money market conditions. It's now running at or above where I'd like to see relative to IORB for a long-run environment of ample reserves. That makes it appropriate to end asset runoff, as the FOMC decided to do. It's not certain where those money market spreads will go from here and how supply of reserves will need to evolve. Temporary factors, including tax payments, Treasury issuance, and banks' quarter-end and month-end balance sheet adjustments, have all contributed to the upward pressure. If those pressures recede, rates could come down relative to IORB. Banks may also continue to adapt to the new configuration of rates. There might then be room for modest further decreases in reserve supply. Once runoff ends, the Fed can further reduce reserve supply by holding assets constant for a time and allowing decreases in reserves to offset trend growth in other liabilities such as currency. But if the recent rise in repo rates turns out not to be temporary, the Fed, in my view, would need to begin buying assets to keep reserves from falling further and maintain an ample supply of reserves. Now, you may have noticed that I focused on a repo rate, TGCR, and not the Fed funds rate, even though the FOMC targets the Fed funds rate in setting monetary policy. And that was intentional. In my view, the Fed funds operating target is outdated. The Fed funds rate measures rates on unsecured overnight loans between banks and other entities, such as FHLBs, that hold reserves. This rate made sense as the operating target given the way money markets worked in the 1990s, when the FOMC began publicly targeting Fed funds. However, the world's changed. Fed funds is no longer a vibrant interbank market that measures the marginal cost of money for a wide range of institutions. Today, the Fed funds market is dominated by an arbitrage trade between a small number of FHLBs and foreign banks. It's idiosyncratic and it's fragile. If the connection between Fed funds and broader money market rates ever broke, the FOMC would need to adopt a different target. So as I described in a recent in-depth essay with a colleague, I believe the time's come for the FOMC to modernize the target rate. Proactively changing to a more robust target, such as TGCR, would allow time for a smooth transition so the private sector could adjust. Let me emphasize that modernizing the target rate would not change the FOMC's monetary policy strategy. The operating target specifies how the FOMC measures and influences monetary conditions, entirely separate from the question of how restrictive or accommodative those conditions should be to achieve our goals. And targeting TGCR would not require a larger Fed balance sheet or larger, more frequent, or more complex operations than targeting Fed funds. To reiterate, though, these are my own views, but I believe the FOMC should modernize the target rate. So I just want to thank you all for the opportunity to share my views with you. As I opened our conference yesterday, I'm a big believer in the power of diverse perspectives. I've learned so much from all of you yesterday, and I really look forward to learning from you more today. I really thank you for sharing your ideas, and I look forward to hearing your feedback on my remarks this morning. Thank you all so much for being here.
Thank you, Lori. I guess we will now go to our first fireside chat of the day with Alessia Haas from Coinbase, which will be moderated by Rodney Garrett from UC Santa Barbara. If we have time for Q&A, we have two research assistants who will wander around the room with microphones, so just raise your hand. So Rodney, Alessia.
Hello, everyone. Welcome to this session. My name is Rodney Garrett. I'm a professor of economics at the University of California, Santa Barbara. My research is primarily related to monetary theory and financial market infrastructures. And I had the pleasure in the past of working at the New York Fed with Lori. So it's a pleasure to be back here. At a Fed. So today we're very pleased to welcome Alessia Haas. She is the CFO of Coinbase. So Coinbase is the largest cryptocurrency exchange in the United States. Alessia has past experience in other CFO roles at Oz Management and One West Bank. She also had senior roles at Merrill Lynch and GE in the past. So today we're going to talk about stablecoins. So for those of you who don't know a lot about stablecoins, the first stablecoin was Tether. It was issued in 2014, and it was really issued as a way to give shelter to people that held cryptocurrencies. And of course, as we all know, the prices of cryptocurrencies are highly volatile. So if you wanted to be able to sleep at night, you wanted maybe to move your money out of Bitcoin, say, into Tether. So Tether functioned in that role. It was also a blockchain-based settlement asset. But now there are many stable coins. The stablecoin market went from around $6 billion in 2019, and today it's worth over $300 billion in terms of total market capitalization. And there are now really two main stable coins. And by the way, I'm talking about asset-backed stable coins. Algorithmic stable coins are sort of off the table these days for good reason. And there are two major stable coins. One is Tether and the other is USDC, which is offered by Circle. And Coinbase was one of the original issuers of USDC. And so stablecoins are a pretty hot topic these days, and that's what we're going to focus on. And we're very lucky to have Alicia because of her experience both in the traditional financial sector and, of course, in the world of dealing with crypto-oriented financial platforms. So we're going to start off by just level setting, and I'll ask the simplest, well, I don't know if it's the simplest question, but the most necessary question: what is a stablecoin?
Thank you all for having me today. I really welcome the opportunity to discuss stablecoins with you. Because as Rod said, I was a CFO of a bank. I was a CFO of a community bank. So I do think I have some understanding of deposits, some understanding of these assets, and have thought deeply about how stablecoins fit into the broader financial systems. So what is a stablecoin? I think you opened really nicely, which is to say what we're going to talk about is non-algorithmic stablecoins. And I want to start with stablecoin can be used as an umbrella term, and it's really important to then understand what is the asset that we're talking about. And thankfully, from the recently passed Genius Act, we now can define a payment stablecoin. And what we're going to talk about here today is a payment stablecoin. A payment stablecoin is, as you suggested, a blockchain-based digital dollar. It is combining data and value with an atomic unit. But for all intents and purposes, the simple way I think about it is this is just the continued arc of technology, and we now have a dollar that is represented on a blockchain. Simplistically, sometimes I think about we had dollars represented on prepaid cards. We had dollars represented by a traveler's check. You have an instrument that you can redeem a dollar. And a payment stablecoin is a representation that you can go redeem a dollar. These are backed one for one. So USDC is the example here, is backed by short-dated liquid money market funds. The majority are held in a BlackRock fund that you can see the daily NAV posted on the BlackRock website. And it gives market participants the ability to have a 24/7 global digital dollar that can be transacted peer-to-peer, B2B, B2C. It provided, as you suggested, the ability to match settlement with the 24/7 global crypto market. So when you are doing trading across the globe and you needed to be able to move money through your various accounts, various exchanges, the timing of the bank system did not match the timing of the crypto markets. And so having a settlement asset that then met the needs of market participants was really important. And that drove this growth that we've talked about. But now we're on the precipice of seeing people adopt stablecoins for payments. And we've moved from it being predominantly a trading asset and a trading pair now into the emerging payment class. And I would say we can get into this more deeply probably in our conversation, but there's a few unique aspects of how stablecoins meet the payment market that I think are really interesting to talk about here.
Yeah, so, well, I mean, why don't we start with that? Why don't you go on a little bit more about what the unique aspects are? Because this is one of the interesting things, which is that stablecoins have existed primarily within the decentralized blockchain ecosystem. So they have a variety of uses within that ecosystem, but they're not typically used by customers of traditional financial institutions. And so one of the things that seems to be happening today is that we're contemplating the idea that stablecoins might be used by customers of traditional banks for payments. And so, of course, you know, the big news recently is after the election of Donald Trump and the executive order and the recent passage of the Genius Act, there's this possibility that, you know, in some ways we thought was, I don't know, inconceivable a year ago, that banks might be able to participate on public, well, not might be, are able to participate on public blockchains. Now, it's an interesting nuance there, because the way I like to think about this is there used to be a no swimming sign, right? So you weren't allowed to swim. So the FDIC and the OCC had given guidance that said that banks couldn't participate on public blockchains without getting prior approval. Well, after the Genius Act, that was rescinded. So that no swimming sign has been taken down, but it now says swim at your own risk because banks have to figure out ways to participate on these public blockchains, but they still have to meet all the usual and very important regulatory requirements that protect consumers, counter against money laundering, and so on. So I guess the question is, how can banks use stablecoins today?
There's so many ways we can answer this question. Just a few thoughts before. I want to talk about what we're seeing in terms of adoption of payment stablecoins as kind of one thought track. I also just want to touch on your comment on open permissionless blockchains. And I want to share an anecdote to just think about, and it kind of dovetails into risk management, which is that there's great value in these decentralized blockchains. And I'm going to choose Ethereum as an example here. It is not the only one, but I want to use it as an anecdote. For the last 12 years, we've now seen a scaled blockchain with no downtime. It has validated all transactions. And I thought it was really interesting last week when the broad market was suffering from an AWS outage, and many companies had a very hard time processing their transactions. Coinbase on our centralized platform included, we saw delays, we saw latency. But where we saw no delays, no latency was on the blockchains. We were able to continue processing transactions. And so I do think that there's a very interesting decision that banks can need to make when they're saying, oh, there's risks in permissionless blockchains. It would be better for me to use a centralized blockchain. But to look at the data, the security, the uptime, which has been at 100% uptime now for over a decade, and to see the value in having a global decentralized network of developers who are continuing to invest. So I think that there's something that we fail to talk about sometimes in the risk management of these permissionless blockchains. All right, where payments were seen. So because of stablecoins being 24/7 and anyone can open a wallet, what we're seeing is a lot of companies are looking at this as a solution for cross-border payments. That is the first corporate opportunity. That's a $40 trillion market. We are seeing companies like Deal, which is a global payroll company that is employing contractors around the globe for many US companies, finding stablecoins an easier payment method to be able to pay contractors in hundreds of countries across the world. We are seeing companies like SpaceX, who operates globally as well, wanting to move money through their corporate intercompany agreements and not take local currency risk by using stablecoins to more quickly repatriate funds back to the United States. We are seeing companies that want to sell goods and services into countries that they don't want to accept local currencies, say, oh, I want to accept digital assets, because these markets are deep, they're liquid, they have the ability to move money more quickly through their network of subsidiaries. So there's one global remittance market that is being served to large corporates that we're seeing grow quite nicely right now. The emerging use cases then for payments, there's a lot of interest and activity around agentic commerce. There's a lot of interest and activity around micropayments. So what is very unique about stablecoins is that they intersect with agents and AI. It's very hard for an AI agent to open a bank account. I think it would be very hard for them to get through any of your onboarding processes to be able to have an agent be the owner of a bank account, but an agent through software can be coded to have a wallet. So I can say to my agent, this is the permissions, this is what you can do. That agent then, online, can buy AWS capacity on a developer's behalf, can get behind a payment firewall to be able to make a payment to get content, to receive more data to inform their search. So as we see the growth of AI and agentic commerce, crypto stablecoins are a very important part of this because it will open up data transactions online. And there's a lot of work with lots of tech companies right now to build these open protocols. What is the language? How will these things interoperate together? And then again, back to micropayments. Much like when we saw the growth of data and the evolution of the internet where we can now text, and we went from texting very infrequently because it was expensive, and I remember my own data plan where I could only send 50 texts a month, and I was like, okay, I've got to be really judicious in my texting. And now with my teenagers, I mean, there might be like 50 texts per daughter per day in my life. And so you just see that growth of transaction activity as the cost comes down, as the ease of use comes down, and we believe the same will happen with payments. Today, there's a cost. It's hard to send a 10-cent payment. Like, who of us really wants to process a 10-cent payment? That is just not what the legacy systems have been designed to do. But that is what stablecoins and blockchains, because when you can have just millisecond costs, it opens up the opportunity for hundreds of micropayments in a way that the current systems were not designed to support. So that's where we're seeing the growth. That's what the value of these permissionless blockchains. And I think for banks, there's a huge opportunity then to be able to get involved here. I think these are services to many of your customers to offer them an adjacent payment schema. Banks have been innovating for centuries. I think that, as I mentioned in my prior comments, we've all seen changes in the payment landscape. We've seen changes in the way that customers engage with cash and their assets. So this is not unique to any of you in the room to watch the evolution of technology impacting the way that customers want to transact with their funds. What is new is this is just a new technology stack. This is a new underlying payment rail. And there's partners out there for you to partner with, but we believe this will just live side by side with existing payments. So as much as it still shocks me, I still write checks. I question whether my children will write checks, but I still write checks. I also send money on chain. So there's a huge spectrum of my activities, and I choose the payment method that best suits the transaction that I'm making. And I think this will be the case of many customers. And so I think being able to offer this as a side-by-side product is a unique way to do this. And the last thing I'll just say, it's a much lower cost payment method. So there are partners, there are APIs, there's service providers that you can work with to really make this an easy way to facilitate.
Yeah, let me just follow up on that a little bit, because so a lot of people, when we think about what the payment benefits are, people in this room might be thinking, well, there are systems in the US like FedNow, for example, or for small payments between individuals, something like Venmo that works very, very efficiently at very low cost. But when we think about payments from a banking perspective, the payments that really matter aren't person-to-person payments, but they're corporate payments. And so one of the things that you didn't touch on, maybe I can get you to elaborate a little bit more, is that one of the potential advantages of using these platforms is programmability. So when we think about corporate payments, treasury management, for example, treasury management systems, as you know, are very complex. They involve a lot of operations involving payment and reconciliation and so on. And there is, I guess, the potential for this to be done using stable coins with programmable, that are implemented through smart contracts on programmable platforms. Can you tell us a little bit about some of those advantages?
Happy to. I'll just comment, you're absolutely right, we have digital payments though, but if you have Venmo and I have Zelle, we don't get to transact with one another. And that is truly the value of these permissionless networks where anybody can receive any stablecoin and just receive it into their wallet and then convert it back to fiat if they so choose. So these are interoperable, and interoperability we think is very crucial. Just like deposits are interoperable or cash is interoperable stablecoins we think is what will be broadly adopted versus these closed walled gardens that support customers just within their own platform. Sorry, couldn't help myself in going there. All right, now programmability of stablecoins. Because this is software, because these are programmable digital dollars, they do open up more opportunities for custom workflows. Simplistically, you can think about, you can create whitelists where you can say, I only permit payments to these X number of addresses. That can reduce risk in many ways. That can say, by code, I have only approved these vendors, so I'm only going to label payments. What I value in my own company and my own role is, because these are immutable transactions, because these are instant transactions, because they are on an immutable ledger, the reconciliation is instant for all intents and purposes. You don't have delayed settlement as you do with many fiat payments, so you're not matching against different institutions. You can see them settling on the blockchain. And so it does change the back-end settlement risk. That is one of the benefits I see to just reduce cost and reduce risk in this technology. But then there's more. You can have, for example, customizable privacy. Do I want this to be a publicly reported transaction? Do I want this to be a privately reported transaction? You can start to configure the conditions about a payment. And that becomes something that empowers customers about the different transactions that they want to do. So I think what is just very unique about this is the configurability. And that can then lend itself to different payment types. It can lend itself to different regulations about different size of payments, that we could create different rules around that. And so I think that this technology is very customizable and very unique in that regard.
So let's continue on with that theme a little bit. So let's talk a little bit about risk. You've been a strong advocate for cryptocurrency regulation. Um, Can you tell us a little bit what the risks are, what type of regulatory action might be implemented to mitigate these risks, and even a little bit like what, as I mentioned in the intro, I work on financial market infrastructure. So what's your view on whether or not we could, the industry could use supporting infrastructures like clearing systems in order to facilitate trades and implement the type of singleness, you didn't use that word, Lori, but singleness of money that's so important.
Okay, like everything, there's risk. And I think with this asset, you have to look at who is the issuer of the asset. What does their balance sheet look like? What are their operational controls? What are the underlying reserves? Is there transparency to those reserves? Is there an audit or an attestation of the reserves? What is the minting and burning? What is the protocol risk? How long has this protocol existed? So you can walk through a set of risks and then understand. What is wonderful about the GENIUS Act in the US is it set forth a framework to think about these types of risks. We have similar rules in the EU with MiCA. So now within at least two large markets, the US and the EU, there's rules that govern stablecoins. And we've been actively advocating for this regulatory clarity for some time because we think that it provides value to issuers to understand how these various assets can be used. It provides transparency to market participants to say, what are the underlying reserves? Like, one of the reasons that we jointly created USDC with Circle back in 2018 is there was a significant depegging event with Tether. A depegging event is when the market price of a stable coin trades above or below $1 because you can redeem them for $1, and so you typically see with market makers that they get traded in arbitrage back to $1. But it fell off and it was at the 70-cent level, and that was because there was no transparency into the underlying reserves, and there was concern about the composition of those reserves. So we do believe that with the GENIUS Act, this clarity around reserve composition, how we can all get comfortable with what protocols these are on, provide a lot of stability there. I think when you get then into additional rules and regulations, I think that there's a lot of conversation today around what should be accepted as collateral, how stablecoins should be used as collateral, and what haircuts are appropriate to those stablecoins, and whether those haircuts different by coin, by issuer. While they may trade at $1 because they can be redeemed at $1, smart money will probably start to evaluate the risks, and they'll look to the issuer risk, the protocol risk, the reserve risk, et cetera. I think we are still developing that. And I don't know, I think that there's an opportunity for the Fed to be very involved with that. I think there's an opportunity for other regulators to get very involved with looking at those other underlying assets and setting then capital and haircut requirements.
Thank you. And so the next thing I'd like to maybe talk about is that, from a banking perspective, banks look at stable coins and they see that these are basically these issuer liabilities that consumers hold. Well, banks issue something that seems pretty similar, which are deposits. And for the last several years, there's also been a lot of interest in this idea of tokenizing deposits. Several years ago with some colleagues at the New York Fed, I wrote a Liberty Street blog that said the future of payments is not stable coins. But what we were basically saying then was just this idea that if you want to leverage the benefits of public blockchains, you don't necessarily need new money. You just need to tokenize existing money, and that is the idea of tokenizing deposits. So JP Morgan recently took JP Morgan coin, and now they call it JPMD, and they've put it onto a public blockchain. Now, as you said, they do this in a very restrictive way that allows it only to circulate within their own customers. But could you talk a little bit about the distinction between tokenized deposits and stable coins and how those two things might coexist?
Absolutely. So a tokenized deposit, some of you might argue you already have a tokenized deposit in some ways. You have digital dollars, and this is just now a USD sitting on a different technology or a different rail than your existing digital dollars. But I want to come back to the theme of interoperability. And so a tokenized deposit is just your bank deposit. You're taking bank risk. A stable coin is taking money market fund risk or short-term treasury risk. A tokenized money market fund is then taking the tokenized money market. So what is the underlying reserve is a really important thing. They're all going to be a dollar, and so it comes back to that haircut concept, or what is the underlying, what is the issuer risk, what is the bank risk? And that is how I think the market will observe these various instruments, for one. But then two, I think customers will say, what is the interoperability? If I receive a JPMD coin, can I turn around and go to Wells Fargo with that? Can I turn around and go to another bank with that? And will they accept that? So what is the interoperability of the acceptance? What is the underlying blockchain that that is on? And then do the other banks have the technology to receive in that underlying blockchain technology? This is equivalent to like if someone came to you with the Venmo or Zelle or the ACH or SWIFT and you hadn't established that payment rail. Can all the banks establish all of the other banks, underlying blockchains and payment rails? That seems very complex to us. So we believe there's going to be convergence and adoption of certain protocols. Our belief is these will be decentralized protocols based on the security and the global participation in maintaining network security, because these will provide more resilience and more uptime than any other centralized maintained system. And so we're believers that within bank balance sheets, you may choose to have tokenized deposits for your own internal efficiency. As I mentioned, the settlement risk is easier. But then when money's in flight, when it's moving between systems, when it's moving outside of the bank's balance sheet, that's when they will interoperate with stablecoins. And so we think these things will live side by side. We think that different instruments will be used for different payment types. When it is a bank to bank, maybe you will take a tokenized deposit. When it's to a bank to an end customer, or when it's the examples I provided earlier, if Deal's paying their employees in 100 countries around the globe, I don't know that all those 100 employees want to receive a specific bank's tokenized deposit. They want to receive something that is more interoperable and has deep liquid markets from a global trading perspective that they can move then into other assets. So our belief is these things will live in parallel and that each asset will then find the use cases that it is best suited for.
Yeah, I think that's right. And I think it ties in a little bit to this swim at your own risk idea, that it'll depend on whether or not banks can figure out a way that they're comfortable circulating deposit tokens across institutions and so on, and then they may become, in some ways, more comparable to stable coins, but we'll see how that plays out. Another thing I wanted to ask you about is the Digital Asset Working Group recently recommended that the Financial Accounting Standards Board look into defining stablecoins as cash equivalents.
Yes.
So I was pretty sure you'd want to say something about that.
Near and dear to my heart. Again, in the spirit of payment stablecoins being backed by short-term liquid T-bills, money market funds, it looks very similar to other instruments that we consider cash equivalents. Not cash, but cash equivalents. And it comes back to, can we accept this as collateral? Are we using this in payment transactions? And we believe that there's many things then that would cause it to be treated akin to a cash equivalent, so therefore should be accounted and treated as such in the wide variety. I think it comes back to clarity from federal regulators around, can these be suitable collateral instruments? I think the CFTC should be looking at this, I think SEC, et cetera, as well. But as we get to common standards, I think it will then affect more confidence in market participants to then look closely at these assets.
Yeah, so I mean, I think it's worth emphasizing that this is a big deal, both in terms of financial reporting, what would allow banks to hold stable coins, and could have significant implications for stablecoin adoption.
I agree.
Yeah. So I think if it might be worthwhile to open this up for, I can believe we have 10 minutes left, so I think it'd be nice to open this up for questions from the audience.
Let's do it. And I wanted to wish everybody a happy Halloween, so.
Hi, thank you for coming to this. So, with the understanding that Coinbase is a lot more transparent than maybe Kraken or Binance, I think something I'm interested in is, when we look at Tether and USDC, do we need more transparency on where the funds are going? I've looked at Tether's balance sheet. It doesn't really add up to what they claim. Or do we need rules about having cash equivalents? And so what's kind of the sweet spot there?
I think the Genius Act has moved us significantly forward because where USDC will then be governed as a payment stablecoin, it's possible that Tether hasn't met the requirements to become a payment stablecoin. So then market participants can say, oh, do I want to be transacting with a non-payment stablecoin? And I understand there's different risks with doing so than operating with one that is compliant with the US rules, and similarly with MiCA. So USDC is also a MiCA-approved stablecoin. So I think that we've moved a good step forward. And I personally think that transparency on the reserve requirements are critical for any market participant to be able to transact with these assets with confidence. Now, Tether's obviously been a huge success. They're a large stablecoin. They're the largest stablecoin. And what I think is interesting to learn there is that is largely a non-US customer base. These have been adopted by many people who just crave access to the US dollar, want to hold that as a store of value asset, and this has been the most accessible way for them to do so. And so I do think there's an interesting takeaway from just the global appetite and demand for dollars where those customers can't gain access to a US bank account or a brokerage account, but these stable coins have given them a vehicle to be able to own that asset in their portfolio.
Daryl?
Thanks. One of the applications that's emerging for stablecoins is in the back end of the financial system for settlement of large financial transactions like repurchase agreements against US treasuries. And that could become a multi-trillion-dollar market for stablecoins. What would you recommend with respect to the extra features for stablecoins that are used in such a large, crucial core market? Is the Genius Act sufficient? International principles suggest that infrastructure for such important markets should be based on extremely safe assets, whereas in the Genius Act, in principle, stablecoins could have a significant fraction of commercial bank deposits as their backing. And are there any other sort of extra safeguards for that kind of market, like the type of blockchain that's used?
It's a good question. So I do think that market participants should look at the underlying reserves, as you note, and I think it comes back to my comment around what haircuts should be applied. And if you are dealing with an asset that perhaps takes more market risk, takes duration risk, takes credit risk of some sort, all of these underlying reserves have some risk to them. And you're right, you need to judge the composition of the bank deposits versus the composition of the T-bills, the composition of the money market fund, how much duration, et cetera. How many steps are there? How many issuers? Where are the assets being custodied? All of that needs to go into a risk analysis to determine which asset is the least risk and could be used for various transaction types. And I think it's akin to what I just shared with Tether. There's definitely market participants around the globe who think Tether is the best asset that they've ever held. People who then have access to the USDC may say, this is a better asset. They both trade at $1, but one has a more transparent reserve composition. So I think that as we get into then large repo, we will then have another conversation. I'm not sure that I think that needs to be federally regulated versus market participants and letting the markets work and coming to an agreement about which transactions they think are best suited to the payment type.
I fully agree with you on the benefits and advantages of blockchain technology and on which stablecoins are based on. But for most participants, the way to get liquidity from stablecoins is to trade them on exchanges. And many of these exchanges are not decentralized. They are centralized, meaning that once the blockchain moves into the wallet of the exchange, actually there's no more way to track, where that went, and, the benefits of the decentralization are basically no longer there. So I wonder how you, think about the future, let's say, cooperation between decentralized stablecoins and centralized exchanges.
It's a great question. I think that we're going to see centralized exchanges and decentralized exchanges and/or decentralized protocols live side by side. And I think there's value and benefits to both. I think for Coinbase ourselves, we've chosen to be a centralized exchange in the United States who seeks regulation. We're regulated by the New York Department of Financial Services. With regards to a BIT license, we follow the same bank BSA, KYC, AML requirements. And so while you're correct that once an asset comes onto our platform, it is not publicly traceable, it is absolutely subject to law enforcement and regulatory oversight for the transactions and the customers on our platform. And so within the framework of US rules, you have actually more visibility because once it gets to our platform, we can see the entire life of the transaction. We can see 10 hops away. We monitor on-chain activity and do address tagging and transaction monitoring. So I think there is value in having centralized and decentralized players within this space in a regulated sense. And I think that, again, and I don't mean to make this sound simplistic, I think it comes to what is the transaction type, what is the customer seeking to do, and what path is best able for them to achieve their goals. And that's where you're seeing various transactions go. You can get liquidity for stablecoins in decentralized protocols. You can only mint, i.e. purchase new, deposit fiat dollars and receive new stablecoins through the centralized platforms because they intersect with the banking system, and therefore we need to have regulated oversight of those who are issuers and minting and burning. But as a smaller market participant, you can buy on the secondary markets through both centralized and decentralized exchanges. But size is really at the centralized today.
Great, quick question here. Wanted to go back to your comment on intercompany transactions for global organizations. So if you were kind of coming in, kind of advising a CFO or CEO of a global company, and can you provide some of the risks and benefits of leveraging stablecoins for intercompany transactions?
Absolutely. So I'll give you our own. We operate in 20 countries around the world. We have to move money throughout our subsidiaries. And what it enables is then 24/7, you're outside of banking hours. So if my treasury team is sitting in New York and we're funding our entity in Israel or funding our entity in Australia, we're not having to rely on time zones. And I can have a more efficient global movement of money to settle out my risks and our funding. We also have, as I mentioned, much more straightforward reconciliations when we're using blockchain-based technology because I'm not patching together relationships around the world who may have different protocols that I'm interacting with, different rules, different mechanics, and so just the timing really settles out. So I view it as just efficiency and less settlement risk predominantly is the value that I get for my intercompany stablecoin operations.
Great, I think we're just about out of time, so maybe I'll just ask one last quick closing question. So do you have any advice for the banks in terms of how they should prepare for this new world of stablecoins?
Yes, I think that you should explore partnering. I think that whenever we're looking at something to do, we think, can we build, can we buy, can we partner? We are great at crypto, we are not so good at, regular way securities trading as an example. So we want to rely on people who are experts at things that we are not experts at. And so I would say, similar to you all in the room, you are experts at deposits, you are experts at lending, you may not be experts or you may not have that talent to do blockchain-based transactions, but there are many vendors in this space. There are many who are offering white labeling of their own technology stacks, as is Coinbase. So for example, we've publicly shared we are powering the back end of PNC as an example to enable them to offer blockchain-based services to their end clients. So just like you outsource cloud services potentially as the wave of the internet change, I think creating your value, which is distribution to your customers, and relying on technology providers to provide some of the back-end tools to you would be an effective way to move forward. And then depending on how time progresses, doing vertical integration, building out that technology expertise of your own over time is probably the best way to move forward. But like with anything, start with your customers. What are your customers' pain points? Do they see value in lowering costs for international settlements? Is that your customer base or not? Are they looking at ways to streamline their own back office? Those are questions you can have. And so I would start customer-led. I would then start, if the customers have a need, how can you best serve that need through partnering with other vendors to help you get there?
Great, thank you very much.
Thank you so much. Thank you for having me.
Thank you, Rodney and Alessia. We've got a 20-minute break. We'll resume at 9:50. y'all can grab your seats and we'll get started. Our next session. Okay.
What order are we speaking?
Okay, so our next session is going to be introduced by Charles Cooper, who's the Texas Banking Commissioner. Charles?
Okay, good morning, everybody. First of all, I'd really like to thank the Dallas Fed and the Atlanta Fed and the Cleveland Fed for putting on this conference on a very important topic, not only just putting it on, but really making it worthwhile. So this next panel is going to be about the importance of the banking system, the role of bank supervision with a fresh perspective on the 2023 banking turmoil, fresh perspective, that'll be good, and the history of interaction between supervision and banking. So I wanted to just say for a little history, if you'll bear with me, the OCC was founded or created in 1863. And around that time, various state banking departments were created. For instance, my department, Texas Department of Banking, we were created in 1905. And then we have the FDIC, came about in 1933. Now the Federal Reserve itself was created in 1913, but its involvement and supervision evolved over time, and they gained more authority as time went on. For instance, in the Banking Act of 1956, they got more authority. But a little lesser known fact, during the Dodd-Frank debate in 2009, there was a strong opposition to the Fed being involved in bank supervision. And it came very close to being removed from supervision. And this is my opinion, and shared by many others. If it wasn't for the tenacity of then Texas Senator Kay Bailey Hutchinson, I'm not sure that the Fed would be involved in bank supervision as we know it today. And I will tell you that I think that the dual banking system is much better off with the Fed involved. And also, I just want to say we appreciate our relationship with the Dallas Fed. The states appreciate our relationship with the various district banks, and certainly our relationship with the Board of Governors is very strong. So this panel is going to go over a little history, hopefully where we are today, and then maybe talk about where we're going. So we have these subject matter experts with us. And first of all, Jonathan Rose. He serves the Fed in two roles. He is the historian of the Federal Reserve System, which is hosted by the St. Louis Fed. And second, he is a senior economist and economic advisor to the Federal Reserve Bank of Chicago. Then we have Beverly Hurdle. She is with the Federal Reserve Bank of New York. She is a financial research advisor in financial intermediation and a member of the research group's Promotion and Recognition Committee. Then we have Peter Conti Brown, who is Associate Professor of Financial Regulation at the Wharton School of University of Pennsylvania. And then our moderator today will be Mark Carey. And Mark is with the Office of Financial Research. The Office of Financial Research, among other things, supports this small organization, insignificant organization called Financial Stability Oversight Council, or FSOC. And I am very, very cognizant of the important work that that group does. So, let's just turn to it. Mark, you want to kick things off?
I've been attending conferences like this one for more than 30 years, and this is one of the best that I can remember. So I urge that we take this opportunity to give a hand to the organizers. We'll go in the order in the program. Each of the subject matter experts will give a 10 to 12-minute presentation, and then we'll have a discussion also involving the audience. So Jonathan, take it away.
Let's see, should I bring out my microphone? No, you're good. You can hear me from over here? Okay, great. Well, thanks for having me. The disclaimer at the top is that I'm only speaking for myself and not for anybody else at the Fed. I'll note that Steve Kelly has joined the FDIC since we wrote this paper, so that's great. We're in a panel about bank supervision. And what this paper is a look back 2 years and change after the 2023 banking crisis, using the benefit of a little bit of time to think about it and some hindsight to just evaluate the literature and what people have concluded about it. And that's the title, Rushing to Judgment. We don't have to rush to judgment at this point. We have 2 years worth of time to think about things. And so what depositors do during crisis is they rush to judgment, and we had to make some pretty quick conclusions in the spring of 2023, but now we have a little bit more luxury. So let's see, maybe I press this button. Yes, good. Let me just describe what I think of as sort of the standard story that has taken hold to describe what happened in March 2023, and then I'll describe our view. And I've put the standard view, I don't mean them to be in scare quotes here. I think this is a fair representation of the way people have generally talked about the crisis. First, there's a focus on Silicon Valley Bank. Certainly it was the biggest of the banks that failed, and often you see descriptions of the crisis that really only mention Silicon Valley Bank or usually focus on it. And then from there, the standard view is that the crisis spread from SVB. There was a sudden scrutiny of regional banks to see whether others had unrealized losses on their securities and uninsured deposits. And then many of those banks had run. Certainly Silicon Valley Bank had a really bad run. And I think the standard view is that those runs were fast because of the advent of social media and digital banking. Okay, so our view is the following, and it's really motivated by Stephen and I there are just some aspects of this standard view that we just didn't understand and wanted to push on a little bit. The first being that there were 2 other banks that failed in March 2023, one being Silvergate Bank, and the other being Signature Bank. And they have a lot in common with each other, but not that much in common with SVB. And so we just found that the focus on SVB as maybe we're missing an important part of the crisis and that we can capture if we think a little bit more about these other 2 banks. And what those other 2 banks have in common is that they were focused on their business models were wholly focused around, were very focused on crypto asset customers. They hosted payment platforms so that crypto asset customers could settle transactions with each other in bank deposits. And in fact, there's a new shock that you bring into the conversation when you think about them, which was the failure of FTX in November 2022, which led to a run on Silvergate. And it helps explain a lot of what happened here, because in absence of thinking about Silvergate and the crypto crises of 2022, it's hard to understand why Signature Bank, of all the banks in the country, was the next bank to fail after SVB, really the day after. But it's much easier to explain if you remember that the other main crypto bank in the country had failed just 2 days prior. That was Silvergate. But the main thing I want to talk about is in this middle box here. As I said, the standard view is that what happened afterwards, there was a sudden scrutiny of regional banks' balance sheet variables, these 2 variables. And our source of confusion as we thought about this standard story was that, as you know, there are hundreds of banks with elevated losses unrealized losses on their securities. And yet, in this instance, only 3 banks failed over the course of a few days in March 2023. And so it is hard for us to understand just based on these two balance sheet variables, why it was that just those three banks failed. In our view, which I'll emphasize first, and I'll talk about the balance sheets variables a little bit more, is that what happened was a scrutiny of business models. And the business models that came under scrutiny were ones focused on crypto customers in the case of Silvergate and Signature, or focused on venture capital customers. What those industries had in common was that they had both venture capital and crypto had been beneficiaries of inflows of funds during 2020, 2021, period of low interest rates. People were looking for alternative investments, and they both came under pressure in 2022, in part as people started putting their money elsewhere as interest rates rose, but also because, as I mentioned, there were some pretty severe problems in the crypto industry, such as the failure of FTX or Celsius in 2022. And so these are macro vulnerable sectors and two banks or a few banks with business models that were very concentrated on those sectors. And for us, this is a much more satisfying, a much more precise explanation of which banks came under pressure than these two balance sheet variables. The thing about these two balance sheet variables, unrealized losses and uninsured deposits, is that, as I said, hundreds of banks have had unrealized losses. So I think, uninsured deposits is this, if you combine it with uninsured deposits in a data mining sort of way, you can identify the banks that failed. But ex ante, it's very unclear to me that of all the balance sheet variables that you can monitor for banks, that these two banks, set of banks really would have popped out as much as they do ex post. In particular, from an historic point of view and from an economic point of view, I have a hard time thinking about a bank needing to have 90% of its deposits uninsured in order to fail from a deposit run, which is what this view sort of implies, that as long as you weren't in the very extreme of uninsured deposits, which was 90%, that you weren't subject to market discipline. Historically, I can give you a long list of banks that came under pressure from runs that were well more insured than that. In recent history, Washington Mutual, WAMU, and Wachovia in 2008, both had large retail deposit bases, and they failed when they had runs from their sophisticated counterparties that had uninsured deposits, but it was only 20, 30, 40% of their deposit base. I think that a lot of banks, they go under a period of, if they've been under a period of extended pressure, and if their business models are under pressure, and then they lose 10% of their deposits when their large sophisticated counterparties give up on them, that's enough pressure, and that's the form of market discipline that we think should be occurring in a banking system. Because historically, when we set up the system of deposit insurance in the 1930s, we made partial insurance the system, and the idea was that we would leave large uninsured depositors as the source of market discipline in the country. And there was no expectation that that would have to be 90% of a bank's customers in order for discipline to occur. That percentage has always hovered in the 40, 50, 60% range for the banking system as a whole and for typical banks. So I think market discipline can extend far downward from those levels of uninsured deposits. And so as a result, for me to really understand which banks come under pressure, I have to think about the business models and those business models becoming uninvestable. And that's why they failed so rapidly. Let me do a couple other quick hits before I turn over to some policy conclusions on the next slide. I mentioned that there was scrutiny of regional banks. That's a term of art, as you know, for banks in a certain size category. But really, if you look at the banks, there are banks of a certain region, which is on the West Coast. And we think that really has to do with the business models they were operating, that of tech-heavy or venture capital-heavy that happen to be located on the West Coast. As for the scrutiny being sudden, we have a hard time with that one. I think that the reason why that investors were so primed to react to bad news about these banks was that they had been monitoring them over the previous year. And so that's why when SVB announced that it couldn't raise capital and Silvergate failed within the same half hour. And I think that's in large part why investors reacted so negatively to that combination of news that coincidentally happened at the same time. And as for the coincidence, all I can say is that I think that's a feature of financial crisis historically, to have multiple things going wrong simultaneously. Finally, on faster runs, I will be fast here because I've spoken about this before and I want to focus on other things, but I'm a little bit skeptical that social media and digital banking are adequate explanations for the speed of the runs. And this is just because I think the large sophisticated counterparties are the ones that have money and they're the ones that execute runs. They're certainly the first ones out the door. And historically, it's very difficult for me to think of a large depositor that was slowed by, say, a week or 10 days from withdrawing from a bank because of technology. I also don't think the large sophisticated depositors get their information from social media. Whereas I think what happened at these banks was that they were heavily uninsured, but their depositors were somewhat special. They were interconnected with each other, and they were all in the same industries. And so as a result, they were economically similar and likely to withdraw at the same time. So let me conclude with, actually, real quick then, I just want to be constructive and reiterate what our view of the crisis was that it was a crisis of a certain business model in sectors that had expanded rapidly but were under pressure, and that and that had, as a result of focusing on those sectors, a deposit base that was concentrated and interconnected, either in crypto or in venture capital. Now, in terms of policy conclusions, let me just focus on the supervisory conclusions at the bottom of the slide. Sometimes I hear about the idea of monitoring social media more. And all I can say about this is just, I think it's important to know what you're going to get out of it. I think if you want to monitor what retail customers are thinking about and aware of, then monitoring social media is a great tool for that. But for monitoring large sophisticated counterparties, I have a hard time viewing corporate treasurers as taking their cues that way. There's a lot of discussion about monitoring balance sheet variables coming out of the crisis, especially those two variables I mentioned, unrealized securities losses and uninsured deposits. And some, I think, I've read observations that people saying that bank supervisors are not paying enough attention to that. I have a hard time with that. I think that monitoring balance sheet variables are the easiest thing to pay attention to. And I would also say, if I only wish it were so easy to know exactly which two balance sheet variables of all the variables ex ante are going to be the ones that are important. I think there's a little bit of over-engineering ex post, knowing how to get those three banks to pop off of a scatter plot. Instead, the way I was always taught how to think about a bank is that balance sheet variables, I owe all my training to the Fed, even though the Fed takes no responsibility for what I say here. But this is what I was taught, that every business model on a bank balance sheet is generated, every balance sheet variable is generated from a business model. So when you do a regression or you do analysis of a bank, these measures are not randomly sprinkled around. They're all part of the same data generation process, which is that business model. And that's why we think that monitoring, especially banks with niche concentrated business models, is so important. And honestly, I think is only going to grow in importance over time. If you think about the arc of history, we've had branch deregulation and technological innovations, so that one good thing that's emerged is banks that are much more diversified than they were in the past. I've read so many stories about banks, communities in Texas in the Depression. You had 5 banks, but they were all doing livestock loans, and so they were completely undiversified. And the ability to branch more has eliminated that, or at least offered a different business model. But I think another thing that it's done that was somewhat unexpected is it allows banks, if they want to find niche customers in a certain industry, wherever they are located across the country, and deliver them a suite of banking products that are designed specifically for their needs. And so sometimes when I talk about this, I get pushback that, Jonathan, are you really saying that supervisors should be monitoring business models? That's not really quite what I'm saying. Instead, I'm saying that, do you want bank supervisors to look at balance sheet variables without thinking about a business model? And I also think that these business models are only going to grow as part of the debundling of the banking system that we're seeing. Thank you, and I'll pass it over to Beverly.
How do I, okay, so how do I get my slides then? Next one? Oh. Okay, there you go. No?
Try going forward again.
Am I doing incorrectly here?
Okay, help is coming.
That's what I was doing. I sent, you don't have my slides?
Hold on.
I sent them. Maybe.
Okay, Peter.
Okay.
I got them.
Slides. I'm going to see how many seconds before you all pull out your phones. Well, I come to you wearing two hats. One as a historian of bank supervision. My co-author Sean Venata and I published this year a book called Private Finance, Public Power, A History of Bank Supervision in America, which starts in 1789 and goes through 1980, to tell the story that about the quirky, often dysfunctional, cumbersome, but mostly effective system of bank supervision that we have in the United States, unique in the world, has served as a sort of spiritual inspiration for bank supervision the world over, but never been replicated in toto anywhere else in the world. I'm going to tell you today a little bit about where that system comes from, what is often regarded as its many flaws, and why reformers, including people like me, so my second hat is thinking about how to make this better, should tread carefully and recognize that it is much easier to make things worse than it is to make things better. So let's start first with the banal observation that you hear often repeated, which is true and not very interesting, and that is this: no reasonable person would sit down with a blank piece of paper and design a supervisory system to look like the one we have in the United States. Dual banking is just one of its features, and you can see why some people in a federalized system, such as we have in the United States or in Brazil or Switzerland or Europe, would want to have both state and federalized participation in supervision. Not obvious that we would want to do that, but not crazy. But then add dual banking to federal fragmentation, where we have located supervision in an insurance company, and in a central bank, and in a chartering authority, and in a financial conduct evaluator. Spread across these agencies, motivated by very different things, and you can see the tensions that exist. An insurance company that seeks to protect the value of its insurance fund is going to look at bank risk differently from a central banker who is trying to evaluate those same risks from a macroeconomic stability perspective. And so too different would it be for a national chartering authority in some sort of competition with state chartering authorities wanting to offer the kinds of chartering services that will make that charter valuable or not. So where did this system come from, and why has it shown itself to be so resilient against wholesale reform? Well, it came from a series of challenges for which the political moment called forth certain kinds of answers. And that meant that all of the reformers across this long, roughly 160-year period of reform never got to take a do-over. There was no mulligan in institutional design. Instead, what political scientists call institutional layering is the dominant feature of bank supervision today. So it was that in the 1860s, in the midst of national cataclysm, the Civil War, the comptroller of the currency is brought forth to solve a problem of financing the government in a world where Jacksonian reflexes against central banking had such a death grip, even as the Democratic Party effectively declared itself independent of the United States. That Jacksonian ethos was still dominant, meaning that we had to figure out a way, or the Lincoln administration had to figure out a way to put forth some sort of currency control, some sort of mechanism to fight against both inflation and provide for government funding, and the national banking system was their answer. Now, dual banking was not obvious in that moment. Indeed, the effort at the time, with the medium of exchange being bank notes, was to choke out state participation in exactly that model by taxing into oblivion state bank issued notes. That was successful. What was not anticipated is that deposits would become the major driving force of money just a few years after the creation of that national banking system, giving us a thriving and vibrant and somewhat chaotic system its lifeblood continuing well into the present. And so what do we do with that from a bank supervisory perspective? What it meant is that we live in a world that is defined by shadow banking. A state bank is called a shadow bank if you're a national banker. A national bank is a shadow bank if you're a state banker, meaning you don't have access into the insights of that supervisory system. Now, at the time, the mechanism for both national bankers and state bank supervisors, the supervisors on both sides, to understand exactly what risks were and what could be done about them came in two forms. One was an informational system. You simply could observe call reports, spontaneous examinations. All of these existed from the 1860s forward. And then what was called the death sentence. You could pull the charter. Something you didn't like was happening as a supervisor, the bank wasn't doing well. You could say, here's what's happening. And if they say, thank you for your insights, you can now go to the door. Your only option was to kill the bank. The cease and desist letters, matters requiring attention, all of the extra tools were creatures of the 20th century, not the 19th. Now, of course, the Gilded Age is not defined simply by the advent of the dual banking system. It's defined also by a series of catastrophic failures in that banking system, some relatively minor, mostly forgotten. The 1884 panic, for example, is not one that we talk a lot about. Some that were so large that they became ushered in Great Depressions. Here, I mean not the one in the 1930s, but the 1890s Great Depression. That moniker was only repurposed for the one that we remember today, much later. And then, of course, the big one, 1907, its panic, that after 6 years of hot national and even international debate, brought forth the Federal Reserve. Now, curiously, the Federal Reserve is layered on top of the comptroller of the currency. That was not necessarily by everyone's preference. Many people, including people like Lemuel Shaw, who was Secretary of the Treasury, wanted to abolish the comptroller of the currency. There was no currency to comptrol anymore at that point from the perspective of national banking. Indeed, the purpose of a central banking system like the Fed was to displace the OCC. And that didn't happen. Indeed, the OCC found its way to the Federal Reserve Board, ex officio, where it stayed for that 20 years, what I've called the first Federal Reserve System. The Federal Reserve sits on top of the OCC and the state system, but awkwardly in this period. Awkwardly because what the Fed is doing here is supervising the Federal Reserve banks, which in turn, as counterparties, quote unquote, supervise member banks. And that supervisory ethos is fundamentally different from a chartering authority. The Fed at the time functions as a quasi-chartering authority. The chartering authority for the Federal Reserve banks is Congress, not the Federal Reserve Board. And the chartering authority for Fed member banks are the states. The state banks were the national banks that first give that charter, but the membership status, joining the Fed, especially during that first period, but continuing still today, is a quasi-chartering effort. Their mechanism of supervision, they're given examination authority right from the jump in December 1913, but the way the supervision occurs, through examination, yes, but often through counterparty evaluation at the discount window and for other payment services at the time. Fundamentally different, indeed at loggerheads, sometimes to fisticuffs with the OCC's approach. One of the great debates in the late 1910s was just how much the OCC was allowed to get access to Federal Reserve examinations, and vice versa. Now, the first Federal Reserve System was hailed as a triumphant success at the time of a debate wherein the Jacksonian ghost stalked the halls of Congress. And that ghost is the first and second banks of the United States had a 20-year charter, time bomb, written in to their statute. So too did the Federal Reserve banks, 20 years. They had 20 years to prove their worth. And if you do a little bit of easy math, 1913 plus 20 is 1933. Can you imagine what that rechartering debate would have been had it been permitted to succeed? It didn't. In the 1927 McFadden Act, at a time when people looked to the Fed to say, what a stunning instance of success, principally in its ability to organize the funding of the government during World War I, not something we would conventionally say is appropriate for the Fed or a central bank. They retired the debate, extended the charter to perpetuity. And then all hell broke loose. There's a really wonderful book I just finished last night, Andrew Ross Sorkin on 1929, I recommend it to you. Incredible to see just how much the Fed zigs and zags participated in making what might have been a significant recession into the Great Depression. Well, I've got 3 minutes left and I'm still just at like 1929. So let me jump ahead a little bit. Here then comes the Federal Deposit Insurance Corporation. Also too, the Reconstruction Finance Corporation, which is its own charter allowed to expire in the 1950s. We continue as a people to innovate institutionally to solve individual questions within a larger bank supervisory apparatus that creates tumult and conflict and incursions and excursions as these bank supervisors situated throughout the federal government and the state government at some sense, at some level of abstraction, are doing the same thing, trying to ensure the safety and soundness of the banking system. But as soon as they pick up the lens that has been crafted in the laboratory of an insurance fund or a central bank or a chartering authority, what is safe and what is sound looks very, very different. And what I would say is I think this is the evolved genius of the American system. Not because it is efficient, I don't think that that would be a word I would use to describe our system. Not because it is always right or effective, but because it is at least correlated with one of the great financial miracles of human history, which is the creation and advent of the American financial system and all that is unleashed, but also in the informational generating capacity to understand exactly what the risks are to the banking system at any individual moment. There's something extremely rich that we get when we have a CFPB style discussion on whether or not these bank business models protect consumers, alongside an insurance perspective that asks questions about whether early resolution for risky banks might be appropriate, alongside a central banker who's looking at correlated risks for macroeconomic stability, alongside a chartering authority that wants to encourage risk-taking and innovation. So let me end then in 2023 with a little bit a word of warning. I think of American banking then as a kind of Burkean exercise. That yes, it is trivial to see areas of problem and inefficiency. It is trivial to be able to look across the landscape of bank supervision today and say, this part doesn't work. It's harder to craft good solutions about how to fix them. And it is extraordinarily difficult to improve the system overall without making it worse. And so that's my word of warning to reformers, is to understand exactly that, I call it the banker's Hippocratic oath. When we say first do no harm in bank reform, what we're saying is this ecosystem, as it has evolved, no planning, no intelligent design, as it has evolved, has done something rather extraordinary. And the perspectives at the seats of that table, whether we're talking about the Texas Banking Commissioner and the FDIC chair and politically inflected participation across that system, is doing something important. The only thing I will say, and just the last minute that I have to say it, is let me go ahead and repudiate everything I just said because I have a reform idea. Then I think I want it to be real and happen, and I recognize that there are real risks that I could make it worse, and that is this. As a historian of bank supervision as the Federal Reserve, I am constantly sprinting into brick walls labeled confidential and supervisory information. And CSI, unlike many other aspects of transparency, disclosure, opacity, and confidentiality in other parts of the government, has a very flimsy legal basis. It's mostly been created, mostly at the Fed, but elsewhere too. And I think my request, my plea as a scholar, is deeply related to 2023. Did bank supervisors cause the 2023 crisis? Did they fail? Well, the chorus from left, right, and center, the Barr report to Congress and bankers to say yes. And my answer to that is, how do you know? Because there's a version of the world where bank supervisors nailed this question. They saw the duration risk, they looked at the balance sheet, and they warned. But I have no idea whether that's true. I'm forbidden to find out. FOIA Exemption 8 will block any request to understand how bank supervisors perform. And I want to say that's not good. It's not good for the banks. It's not good for bank supervision. It's not good for public policy. It's not good for scholarship about banking. Because that fortress preventing the flow of information, it has no time limit. It exists forever. And I think that that's a place for reform. And I don't know how to do it without making it worse. But I would like to see some version of that, and there I will conclude. Thank you.
Okay, that should be good.
All right, second time lucky. Okay, all right. Okay, well, I missed my first slide. So I'm delighted to be here today. I have to give the disclaimer that my remarks are my own and not the New York Fed or the Federal Reserve System. I'm going to try I'm not a historian. I was an American Studies major in college many years ago, but so I'm going to try to weave some thoughts about supervision with a particular focus on some of the events of 2023 and some of the funding issues that we were talking about yesterday will all kind of weave through my talk today. So I just want to start off by saying there's a really nice recent study by the Basel Committee, which is mentioned there, that identifies 3 key pillars of effective supervision. I think those pillars, kind of make a lot of sense in a logical flow. They're sort of see something, say something, do something with consequences, and then share information about what you've done, although relative to what Peter was just saying, this is mostly inter-supervisor sharing that they focus on. What I'm going to focus on today is the first of those 3 pillars, risk identification and assessment, and sort of talk about one answer to the question, how can supervisors know which banks are becoming riskier, and therefore where supervisors might devote more supervisory attention. So in particular, I want to talk about identifying potentially insolvent banks. I know that this is not a conference about capital, it's a conference about funding, but wait, I'm going to bring those 2 pieces together. So I'll just start by noting that conventional measures of bank capital, as was discussed yesterday, are grounded in accounting rules that don't always take account of the timing of payments or changes in market rates and prices, and therefore they don't embed some critical risks such as interest rate risk and liquidity and funding risks. So I'm going to ask the question, would a solvency measure that incorporates the timing of payments and integrates funding risk better capture the risks of individual banks in the banking system? And no surprise, my answer is going to be yes to that. And what I'm going to talk about in particular is the results of a paper that we call Bank Economic Capital. This is co-work with my former colleague Matt Plosser. So we calculate something that we call economic capital, which basically is just a solvency measure based on the present value of assets, liabilities, and necessary expenses that incorporates the timing of payments. We calculate this, maybe to Peter's point about transparency, using publicly available regulatory report data, the call reports, for nearly all US commercial banks between 1997 and today. There are a ton of technical assumptions. This paper is 45 pages long with a 52-page technical appendix. So that's as much as I'm going to say about any of the technical details. But the key point is that economic capital, or EC, provides an integrated measure that can be used to assess the impact of funding and liquidity risk on solvency, and can also be, you can run scenarios with suppose this happens to interest rates, suppose that happens to credit spreads, suppose some of the other assumptions in the model differ. So what does it look like? So this chart shows our estimates of economic capital relative to assets, a sort of a economic capital leverage ratio. There's going to be a few charts that look like this, so let me take a moment to explain. The blue dots are the average across all banks in any particular quarter. The red triangles are the weighted average by assets, so that's kind of telling you what the large banks are doing. The gray shaded areas are the 5th and 95th percentile. So, and the other lines are interest rates and credit spreads. So what you can see is prior to the global financial crisis, that the economic capital kind of went up and down, but varied around 15%. The number itself isn't that interesting, but it's about the same for big banks as small banks, as the blue and the red are kind of on top of each other. the number, economic capital drops. There's a significant share that have economic capital that's negative at the GFC, and then it recovers and after the GFC with big banks. So the red dots, the red triangles are above the blue dots. So the big banks are recovering faster and more. And by the time, although it's come down since its peak right before the beginning of the interest rate cycle in 2022, it's higher than it was, prior to the GFC. So you may conclude from this, well, look at all of the efforts that supervisors took to, and regulation took to raise capital, particularly at large banks where, were reasonably effective. There's more economic capital now than there was before the crisis. So hold on to that thought. We calculate a second version of economic capital that we call run economic capital. So here we say, suppose a bank suffered a run and it lost all of its uninsured deposits and had to replace them with market rate financing. Let me say, this is not some dynamic simulation of a run where first this happens, then that happens, and the other thing happens. This is just a swap out uninsured deposits for market rate financing. What would happen to the value of economic capital in that circumstance? And the key idea here is to kind of say, if a bank suffered a run and it had this very negative outcome for its funding, would it still look solvent? Because if it still looks solvent after a run, maybe it's less subject to a run. So what does run economic capital look at? This is the chart here. There are some similarities and some differences to the chart I showed you a moment ago. The main one that I want to point out is post the GFC, the red dots, the big banks are actually below the blue dots, and where they end up is below where they were before the financial crisis. So based on our measure, if you look at the banking system as a whole, particularly the large banks, subject to a run, there's actually less economic capital than there was before the GFC. And we can see this a different way, where this chart just plots the difference between economic capital and run economic capital. It's always negative because run capital is always less, and you can see that the amount has increased. That's sort of the loss given a run, or the exposure in a capital sense of the industry to a run. Has increased, particularly for the big banks. It's come back since 2022, but that's mainly because economic capital has fallen, not because run economic capital has increased. So there's the picture of sort of where we are as a system, banking system, in terms of resources against a run is maybe not quite so cheering. Now I want to pivot and talk about 2023. And so what we did here is we identified the four banks that failed. I would note that we included Silvergate here. We just did it. We maybe should have sold that result more in the paper. But so we look at SVB, First Republic, Signature, and Silvergate. We calculate run economic capital. Those are the colored lines, notably at the bottom of this chart. The blue dot is the average for the industry, and the gray bars is the 95th percentile. And we focus on the period from 2018 to right at the end of 2022. And what you can see is that these four banks looked pretty bad under this measure as far as 5 years before they failed. This is, really just looking at their balance sheet and present valuing it and assuming the run. And they are at the bottom and would have been, if one had been monitoring a measure like this, would have said, these are some banks that we maybe want to take more look at from a supervisory perspective. So what would other measures have told you? So here what we did is we focused on the 135 banks with assets more than 10 billion as being sort of more like the ones that failed. And then we ranked the measures. So 1 is the lowest measure, through 135 would be the biggest, right at the end of 2021, so right before the rate increase cycle had begun. And under our run economic capital for the 4 banks, we get 1, 2, 3, and 10. So, you know, there are some other ones in there. If we look at EC without the run, it's not, you know, frankly, it doesn't tell us much. You know, they're much closer to the middle. If we look at tangible common equity, which in our paper is our proxy for regulatory capital because it's defined consistently over a whole sample, you would have picked out Signature and First Republic and maybe Silicon Valley, but Silvergate is a big swing and a miss there. And if you look at what was a very popular measure, has become a popular measure, mark-to-market TCE, or sometimes called market-adjusted TCE or MATCE, where what you do is you take the unrealized losses on securities or the unrealized losses on securities and loans, but you don't do anything to the liability side of the balance sheet. This measure, you know, doesn't identify these banks at all, and that's because, you know, as Jonathan pointed out, there were so many banks that had unrealized, you know, had the potential for, you know, for unrealized losses at that point. So you may say, okay, well, you back solved for, you know, that crisis. What about something more generally? Here we look at all banks that fail in our sample period. There's like 460 something of them. Most of them failed during the GFC, so that's mostly about credit risk, not interest rate risk. And what this does here is sort of show for different measures on the y-axis, like what percent of failing banks do you capture, and on the x-axis, as you go and you sort of look at a cutoff ratio for the measure, what percent of banks that didn't fail would you also capture, and you want to be kind of up and to the left, and you can see that REC, you know, just does a better job in general than TCE or mark-to-market TCE. So if you wanted to capture 75% of the banks that actually failed with RCE, you'd get 25% of the banks that didn't fail. If you looked at these other measures, you'd get 50%. So in general, this measure, you know, is it perfect? No, but it does a better job than some of the more conventional accounting-based measures. So why? And we think the key thing is the valuing of the liabilities along with the assets. So this just shows, we looked for the 460 something banks that failed. We calculated run economic capital and its major components in each quarter up to 24 quarters before it failed. You can see that, so the line I'm pointing at here, that is REC, so 24 quarters, it was like at the 30, these banks on average were kind of at the 35th percentile. About 8 to 9 quarters before failure, they began to fall further. If we look at assets, where were they? They're kind of in the middle, right at the 50th percentile. There's nothing signaling a problem here with assets until, if anything, they rise a little bit in the distribution until about 10 quarters before failure. What really makes the difference is this liabilities line, which starts out high and is increasing for these banks over the entire period. So in summary, I think that economic capital is a useful measure for identifying heightened insolvency and run risk that could usefully be incorporated into the supervisory toolkit. It's helpful, I think, both for individual banks and for sort of more, you know, macroprudential purposes, as I've shown. And the key is considering both sides of the balance sheet, integrating that funding as part of the assessment of solvency. So, thank you.
On? Yes. So for 10 to 15 years of my career, although I'm a financial economist, I functioned as a bank supervisor. And that percentage of functioning as a bank supervisor increased during basically 2 episodes. So I want to say something that I believe all the bankers in the room probably know, but maybe don't know, and that is for a bank supervisor with a proper attitude, and that's really a banker's attitude, it is so easy when an exam team comes into your bank to know who's well managed, who's aware of their risks, who's doing the right things about their risks. And you probably know this, Because when you do due diligence on your bank counterparts, you probably believe you can tell the sheep from the goats. Okay, so for the purposes of this panel, what this means, I think, is that banking supervision is a technology for risk awareness, risk control. It's got weaknesses and strengths, but the weakness is not in the recognition part, really, right? The weakness is in the doing something about it part. So I'm going to ask questions, except I've got one more observation to make. And that is, this is just my opinion. I have no big experience, but I believe the strength of the apparently chaotic US supervisory and regulatory system is innovation. Many of the innovations in supervision and regulation that have spread throughout the world have come from the United States. And I think that comes from the fact that the agencies compete with each other, right? And there's just more opportunity for innovation. And we can ask how important innovation in Sup and Reg is, but in a world where there's very rapid innovation, as we heard from the last panel, it seems to me we should value innovation. We want it to be, impose as few costs as possible. Okay, so first, I'm gonna go in reverse order with my questions. So Bev, you know as well as I do that if you go to a bunch of bank supervisors with your quant tool, with its 50-page technical appendix, and you try to convince them that this is the thing they should look at in their hearts, it's going to be a hard sell. But it seems to me that what's driving your REC is the increased funding from deposits, especially over the last 10, 15 years, right? Your declining line of REC goes along with some charts that we saw earlier in this conference about increased use of deposits. How adequate would it be to just say to the supervisors, you know, what you should do is look at the deposit dependence, the runnability dependence, and then modulate your message to the bankers about being prepared for the run, right? Get your collateral pre-positioned. Is something going to be missed, or is that approximately in the ballpark?
So, is this on? Yes. So I just, actually, we have given and presented this paper many times in many forums to supervisors, and they have been very interested in it. The number one question I get is, can we see the numbers for the banks in our district? So there's actually, been a lot of interest from the supervisors that we've shown this to. It's hard to argue against the idea that supervision should focus on the liquidity and funding risk of a bank. And I think, to the best of my knowledge, that actually is a big, there's an L in CAMELS, and it's one of the 3 pillars in the bank holding company framework for large banks. I think what our model shows, or what I would say what we're doing, it's the bringing together of both sides of the balance sheet that talks about fundamental solvency under run conditions. And so I do think there's something more to it than just focusing on the on the deposit side of the balance sheet, although I think that is critically important, at least to my understanding of what supervisors do and what they focus on.
Thank you. Peter, attack my assertion that the system is better at innovation than other systems.
The great challenge for any historian trying to evaluate something systematically is the counterfactual. So I don't even know how I would specify that kind of question. So I'll reduce your observation by adding a friendly amendment. I think that by creating this fragmentation, I mean, you're structural analysis would be situate 5 supervisory agencies doing exactly the same thing and have them compete against each other. That'll be better. That seems a heavy lift. And indeed, what we have seen in a few instances, I kept on describing the OCC as having prerogatives to increase chartering and promote innovation, but that has actually been incredibly cyclical. Sometimes that has been the case. The Saxon years during the Kennedy and Johnson administrations are such an instance. We might be in that period again today with a strong and public commitment toward chartering, but for long stretches of the OCC's history, it seemed very much hostile to the idea of novelty in banking, and de novo charter applications could take decades and millions of dollars before ultimately being denied. So I think that fragmentation for fragmentation's sake wouldn't necessarily obtain the same competitive benefits that we might see in a capitalist system, simply because of things like the sclerosis that can exist within these kinds of bureaucratic tendencies. There's also something that I've been observing mostly as an outside scholar, friendly critic of the Federal Reserve, is an institutional ethos of such abject conservatism that the idea of ever making an error is the cataclysm to avoid. And that seems to me to be epistemologically incorrect. We've got to see supervisors leaning into some of these risks, right? And so that's why I would say I'm a little bit skeptical of that assertion. But here's where my friendly amendment would exist. When we have supervisors that are fragmented, doing different things, trying to grasp at different parts of the elephant, then we have a richer description of what we're looking at. That's why I think, a lot of people want to abolish the FDIC or collapse everything into a super agency. My co-author and I, building on other work done by others, counted 22 serious efforts, proposed legislation, beginning almost in sync with the creation of federal fragmentation in 1913, to do precisely this. They've never succeeded, most recently, of course, this year. And I think that's something that we should cheer, the lack of that success, because of the point that I was making earlier. It is a really different examination approach when you're looking at it from the perspective of insurance versus macroeconomic stability. And there, I don't know if competition is the right frame for it, but there's just a robust discussion because the statute is written so broadly, giving so much discretion to supervisors, that a safe and sound bank is going to look really different if you're focused on things like unfair and deceptive and abusive acts and practices, or if you're looking at macroeconomic stability, what we now call macroprudential supervision, or if you're looking at protecting the value of the deposit insurance fund. I think those are really valuable insights to have around a table. So I would not favor that consolidation for that reason.
Can I jump in there?
Yes, then I have a question for you.
Oh, well, I was going to say, you're correct, of course, if you consider the group of banking regulators, but we could expand it to include the Federal Home Loan Bank System, which was technically not a bank regulator, and so you were correct. But they were eliminated. It's one of the few times in American financial history when we did eliminate a financial regulator. So that would turn it back on you, Mark, to say, what have we lost with the elimination of that charter and that chartering competition? There is something to be said about the system is more dominated by securitization than ever, and it is probably harder to start a portfolio lender interested in doing mortgage lending. As a result, I don't know if there's a lot of innovation on that, but that would just be the one amendment historically. But otherwise, I agree with Peter.
You mean OTS, right?
Oh yeah, sorry. Well, it was the FHLB and then it was OTS.
Yeah.
Okay, so Jonathan, business models matter. How should a supervisor balance evaluating the risk of a business model, and it's unusual business models that are likely to look riskiest, against not crushing innovation?
Right. I am on. Yeah, and we have to support private sector innovation. We can't have the banking system stuck in the past. What I would say is that you don't want supervisors analyzing financial information without the business model information. If you analyze, like for example, suppose you could read off of a call report the percent of your business that comes from a certain industry, venture capital or crypto being the two examples I talked about, then you would get those banks popping off the charts. And I'm sure there would be others. But we would agree that just because a bank is several standard deviations away from the mean on a concentration in one business line doesn't mean that it's inherently dangerous. You need to, I mean, the buzzword that's popular today is I'm sorry, that sounds derogatory, but the concept that's popular today is tailoring. And tailoring, you know, the way you view a balance sheet and the way you view regulatory requirements for the business model would seem like the appropriate thing. You know, I think a good example of what you're talking about is the evolution of crypto regulation, which has evolved away now over the past year from a specialized unit. And I think, you know, if you look back though, and you think about the crises that happened in the crypto sector in 2022, there was something to be said for devoting special attention to the risks that could come from contagion to episodes like the failure of Celsius or FTX. But as regulatory imprimatur of the Genius Act and other developments extend to the industry, we should update regulatory requirements. But if you have novel activities occurring in areas that are outside of traditional regulation, and if the industry is experiencing fraudulent activity, like, you know, we do have 2 people in prison from the 2 institutions I just mentioned. It does, isn't there something to be said for spending some regulatory resources to monitor that a little more?
As I read the clock, we have 5 minutes left, yes? Okay, we're going to take questions from the audience.
So as a banker, one of the last things I want is more supervision or metrics. But the EC and the Run EC are fascinating to me. I think maybe even more important than a supervisory framework would be a bank monitoring framework. Has there been any traction or efforts with the ALM modeling software or industry in using a metric like this?
I can't speak to what's done in, you know, in the industry. So I guess my answer to that question is I don't know. The monitoring, you know, in the supervisory context, the monitoring for where, you know, there's scarce supervisory resources, you know, whether it's at a, you know, very large bank or I think more relevantly at the portfolio of smaller banks. So where does the supervisory team want to spend its time and its effort and its attention? And I think that something like this is useful for precisely for, you know, that kind of monitoring effort. It's not foolproof. You may go in and monitor and say, you know, no, this is off for, you know, for whatever various reason. But I do think, you know, there is, you know, a fair amount of academic research. I've contributed to some of it showing that, you know, banks where supervisors spend more time and attention are safer. They are safer precisely when times are bad. And good times, they look pretty much the same as everybody else. Not really hurt in terms of profitability and growth. So there's value to that supervisory attention when it's directed in the right place.
In fact, the people in the, yes.
Good morning. I just want to thank Dallas Fed for holding this event. It's very informative and provides information concerning what future models within finance look like. I do have a question that I'd like to gain some input from Mr. Peter Brown. I really like the sentiment concerning a level of conservatism, but we are actually reviewing historical facts of quantitative easing that has been passed over 7 times since the Great Depression, and how that could be applied for space development, given the challenges the industry actually has. How do you think the financial regulators can collaborate with other agencies to see what kind of financial models can be put into play?
I don't know how well I tracked that question, But I can respond to a broader question, which has come up in all kinds of contexts, which is the nature of the lanes that especially the Fed, but other financial regulators occupy. When your responsibility is money, all of it, or stability, all of it, this is much broader than questions of, run EC or a CAMELS rating. This is about, human flourishing. This is about the contributions that we might make with these unique tools to all kinds of areas. There's one version of this debate which has become de rigueur in 2025, which is to say the Fed has gotten out of its lane, that we need to get back to the old time, good time way that the Fed was before the GFC or woke America or whatever might be. And I think that there are some good aspects to this, no doubt about it. I have been on the record to criticize some prominent principles of the Federal Open Market Committee who have seen as their purview, since stability is so broad, money is so broad, to comment on everything under the sun, even participate in political campaigns. I think that is extraordinarily inappropriate for central bankers to do. And I was very heartened by the fact that the Board of Governors issued a new code of conduct that would forbid such activities. At the same time, there is no golden era of the Fed's history where they stuck to their knitting, narrowly defined. The Fed has always seen stability and money as an extremely broad category, and you pick a year in its history. You pick a time, the Vietnam War, civil rights, obviously the Great Depression with everything that was happening there to it. I mean, Mariner Eccles was cheek by jowl with Franklin Roosevelt as primary sponsor, and much to the animosity and antagonism of both actors, Henry Morgenthau and Mariner Eccles together, who hated each other but had to work together constantly throughout the Roosevelt administration. This was always the case, and in some sense, it has to be. And I think that's the spirit of that question, is the Federal Reserve in particular, but the other institutions as well, are doing something that isn't so narrowly defined. Even if you want to look at price stability, it's not so narrowly defined. It affects nearly every other aspect of what economic policymaking does. That doesn't mean that there aren't limits to these things and there aren't consequences to traversing those limits. But it is important for us not to create a verisimilitude where the Fed just does a tiny little technocratic thing that has no implications for the way that we structure society elsewhere, because that's not a part of our history. That's not a part of our reality.
We're out of time. Thank you all very much.
Thank you all. We'll have our final session at 11 o'clock. Grab your seats. Get our final session started. Okay, welcome to our final session. It's a fireside chat with Presidents Bostic and Hammock from Atlanta and Cleveland. It's going to be moderated by Brian Chung from NBC. Take it away, Brian. You've got 1 hour until noon. Thank you.
Great, thank you so much, Mark. Appreciate all of you having me here at the Federal Reserve Bank of Dallas. Just to introduce myself, my name is Brian Chung. I am a business and data correspondent with NBC News. It is a pleasure to be joined here this morning with the Cleveland Federal Reserve President, Beth Hammock, as well as Atlanta Fed President, Raphael Bostic. And I think I'll just begin by having you say any hellos, any remarks you'd like to say to the crowd, as well as any disclaimers as well if you need to.
I'm thrilled to be here. I think it's been a great agenda and really appreciate working with President Logan and her staff and President Bostic in pulling this together. I think it's been a good session to get people talking about some of the changes happening in bank funding. And so appreciate everyone coming and everyone participating. And I will say the health warning that we always say, that the views I present are my own and not necessarily those of the Federal Reserve Bank of Cleveland or the system.
I'll just say +1 to everything she said. And just to say, like, this has been a great conference. I think it's really important that the Fed system does these sort of things. And it's just been a joy to work both with Beth's team and Lori's team to put together a program that's been quite interesting. I hope you all have gotten nuggets to take with you to think about how we might move forward to improve the systems and make sure that we have a banking system and a payment system that continues to serve the needs of all Americans.
And +2, my views also do not reflect the views of the Federal Reserve Board or the system. But I wanted to start off with a little bit of a fun question, because obviously there's a lot of news going on. We'll talk about the economy. We'll go into some of the nitty-gritty of what's going on in the bank funding space. But as I was walking into the Federal Reserve Bank of Dallas today, it was my first time here, I saw there was something on one of the screens on the pillars coming in that said there was a watch party of some sort for the FOMC press conference, which happened on Wednesday, which got me a little nervous as someone that is in the press room asking questions of the Fed chair. So I wanted to ask, what do you do as Fed presidents during the Fed press conference? So the decision comes out at 2 p.m. and at 2:30, are you still in DC? Are you already off to the airport? Like, where are you guys? What are you doing?
So it kind of depends on the day. The meeting usually ends by something like 10:15 or 10:30 on that day. And so generally the presidents, sometimes I'll catch a plane back to Cleveland, so I'll be on the plane when the press conference is happening. Sometimes I'll do meetings on the Hill to meet with different congressmen and senators and just kind of hear their perspective and share some of the views that we have. But if I happen to be on the ground and available and have the time, I will sit and watch it very often.
It's the same. To be completely honest, I rarely see it live. So, we're running around. I'm not in DC all the time, so it's an opportunity to go see lots of folks. But if I happen to be on the plane, Delta shows CNBC, and I always turn that on.
Catch the live stream
to make sure I can see it live. But in general, they send us around sort of the transcripts afterwards, and there's always a way to see it. This is very interesting. But you always look great.
Oh, thank you. Very kind of you. Very kind of you. That's good to know. I didn't know if you guys all had like a big popcorn party or a pizza party or something like that somewhere.
No, but they do, like, I know in our building they do have a watch party as well. And
We do in Cleveland too. Yeah.
Well, that's amazing. I want to now get to the substance of the meeting. So the Fed cutting interest rates again, second time, back-to-back meetings, back-to-back months. I wanted to get your clarity on what you decided on, because it seemed like there was a kind of fanning out of different views on whether or not the Fed should have cut interest rates by a quarter point. Did both of you support that decision on Wednesday?
So I eventually got behind it. I've been on record for most of this year that I thought that one cut would be appropriate as we tried to figure out how the economy is working. We have our mandates, their intention. There's weakness in the employment side, but there's also, we have not been at target for almost 5 years on the inflation side. And so figuring out which one is the most significant, I think, is important. I was able to get behind it because it's more than where I was, because I still think we're in restrictive territory. And that, to me, is the most important thing. We can't really signal or forget that inflation is a significant problem, and we have to get that back down to our 2% target. And I think we can still do it, but with each step, we get closer and closer to neutral in ways that make me uncomfortable.
Yeah, so I would have preferred to have held rates steady at this meeting and not have to reduce rates. As Raphael says, it's a challenging time for monetary policy. We're being challenged on both sides of the mandate. We have inflation that is too high. It's about a percentage point above our target and has been there for a long period of time. My projection is that it's going to stay there probably for the better part of next year before it starts making its way back down to 2%. And on the other side, we've seen some emerging signs of softness in the labor market that we need to be attentive to. There are a bunch of headlines that were out even this week about layoffs that are starting to happen. When we look at the data at the Cleveland Fed, we track that WARN notice data pretty closely. We're not seeing an uptick that's concerning, but these latest announcements will flow into the October data that we'll see in middle November. So we'll stay current on that. And so I think that given the move that we just made, I think we're right around my estimate of neutral. I think we're barely restrictive, if at all. And so I do think we need to maintain some amount of restriction to help bring inflation back down to target.
So Beth, just to build on that, now that you've said that you didn't necessarily support that cut yesterday or earlier this week, what is it about the inflation picture that has you worried? Do tariffs kind of bake into that concern, knowing that it's still only been a few months that we've seen some of this current administration's tariffs kind of starting to take bite?
So the inflation picture is not just tariffs. When I'm out with businesses and when I'm traveling through Columbus and Cincinnati and small towns like Worcester in Ohio, I do hear people focused on tariffs. I hear the manufacturers are talking about it, importers are talking about it, even retailers. If you're running a grocery store, they're talking about tariffs, and they've been absorbing some amount of those costs. But they are starting to get to the end of that. They've gone into that margin compression about as far as they can from what I'm hearing, and that they'll need to start passing that on in the near future. But tariffs are really just one piece of the puzzle. I'm also hearing about concerns about electricity prices are continuing to rise, insurance prices are rising, whether it's property and casualty or health insurance. And so it's much more broad-based. And so one of the things that I'm focused on is it's if you look at that core services ex housing, there's been little to no progress in that over really the past year. We were at 3.6 last August. We were at 3.4 at its most recent reading in August, which is up from where it had come down to earlier in the year. And so to me, that's not tariff related. It's hard for me to see that core services ex housing is being driven by tariffs. And so you take that plus the tariffs, and that to me creates a more concerning picture.
And I would just emphasize exactly what Beth said in the sense that we have a survey center. We do run a lot of surveys. We've been asking businesses sort of, are you feeling price pressures? They all say yes. What is the source of it? And one thing that's been interesting, less than half of the source of upper pricing pressures are being reported as tariffs. It's about 40%, and I think in our survey of business uncertainty. So it is much more broad, and the stalling out of the progress that we've been making. We've made great progress. Inflation was much higher than this 2 years ago, but we haven't gotten all the way there. And we are committed, I'm committed to making sure that we get to that 2% target, and we're gonna have to do more and see more progress before I'll be comfortable getting us all the way back to neutral.
And you mentioned even on this decision, Raphael, for you did support the rate cut, but you had to eventually get there. I mean, tell me about the change in thinking, especially knowing that we're kind of, as the Fed chairman described it, driving through fog right now with the absence of at least on the labor market side of things, jobs data coming from the Bureau of Labor Statistics.
So I'm going to say two things on this. So one, I actually really like the fog analogy. I think it really describes for me an approach, a philosophical approach to doing policy, which is when there's so much uncertainty, there's so little clarity, it's preferable to go slower. Take your time, don't rush to somewhere, because you may discover that you actually took a turn in the road that you didn't know because you couldn't see. So going slow, being moderate in approach is important. The second thing I did want to say, though, is that we're not completely flying blind. So at the Atlanta Fed, we have a whole survey center 6,000 respondents give us information over a quarter. We have a bunch of advisory councils. We have 11 advisory councils that are sector, pictures of individual sectors. We have a staff that goes out and talks in unstructured ways to leaders across the 6th district. We get maybe 100 or 120 of those in a cycle. And then we have 44 directors of boards across my 6 locations. So we get a lot of information. It's qualitatively different than what you get in the federal government side, but it is informative, and it does really allow us to have information that's useful. And I'm just talking about what we do. I know every one of my colleagues is doing the same thing, and that doesn't always get the kind of airplay that it could, but it is really important, particularly in a time where we're not getting the same volume of data from the federal government.
Yeah, what are you looking at, Beth?
Yeah, no, I'll just echo that. I think this is a moment when the reserve banks and the bank presidents really shine, because all of us are going out and spending time in our districts, getting to know individuals, businesses, communities, and getting a really robust picture of what's going on. But there is no, I don't want to overstate, I mean, it's critical information that we're getting, but I don't want to understate that, you know, the BLS data is the gold standard of data the world around. And so having that does help complete the picture. Having longer data series that you're comparing things against does give us better visibility, but we absolutely have a lot of great information right now that we're relying on. And oftentimes when the economy is shifting and when you're at these pivot points, I find that these anecdotal conversations can be good leading indicators of where we're headed. So we'd be leaning heavily on this part of the information set anyway. It would be nice to have the BLS data to complement it, but it would really just be a complement.
And, you know, when we talk about the labor market, because that is where I guess we're not getting that gold standard data, because we did get one CPI report on inflation, albeit a little bit late. But on the labor market, it seems like the justification for doing these interest rate cuts is to make sure that there isn't any sort of substantial deterioration in the labor market, which I asked the Fed chair in presser on Wednesday, and he seemed to say, we're not seeing signs of significant deterioration, but look, we're keeping tabs on it. From your perspective, I mean, Beth, you mentioned there were these big splashy layoff announcements we saw from some companies, Amazon, UPS, Target, GM, the list goes on. In the absence of government data, are those anecdotes weighed a little bit more heavily? And how do you figure out what is going on in this labor market, since it's such an important part of the decisions and the policies that you're choosing to make as of the last 2 meetings?
Yeah, so I would say that when we moved in September, it was because we'd seen that sharp drop off in the payroll prints, right? We'd gone from being around 100,000 of new jobs being created to being, I think the average over the last 3 months that we have is about 29,000 per month. And so that was a notable drop off. Now there's a question of, is that supply driven or demand driven? Because it aligns with a pretty meaningful shift in terms of immigration policy. And so that I think was really the catalyst. Since that moment when we saw that shift down in job creation, we've been watching a whole host of other data. And so yes, we don't have the BLS numbers, but we do have the weekly state numbers coming through. And those have been low and pretty consistent with where we'd seen it. We are looking at things like the WARN notices, and as of its last reading, which went through September that we got in the middle of October, it had ticked up very slightly, but is still within historical ranges. The Chicago Fed had put together an indicator that they're using that helps to predict where things are coming, where the labor market is going to be. And so there's a host of other data that we're looking at that to me says maybe there's been a shift, but it's not obvious that that shift is coming just from the demand side. I think there is a supply side to that story, but it would be really helpful to have more information to help round out that picture.
Yeah, Rafael, how do you see the labor market now?
Yeah, look, I think the labor market is incredibly difficult to interpret today. There's a lot of churn that's going on, and for me, one of the questions that I've been trying to focus on is to what extent are the changes driven by cyclical things as opposed to structural things? Now, we know that there are big structural things happening. I talk to businesses all the time. They tell us, we're a lot more reluctant to hire entry-level folks because we think that AI can do some of these things, and we're going to experiment, and we're going to try to figure those things out. I hear about those sort of technological changes influencing the demand for labor pretty significantly. Beth mentioned the immigration policy. That could wind up being a structural change that happens on the supply side. That could be significant. If you think about the changes in our trade policy, to the extent that that leads businesses to fundamentally change how they source inputs for their materials, that's also a structural change. And monetary policy doesn't do very well in influencing the trajectory of the economy if there are structural things that are going on. On the other hand, there are cyclical things. We have heard uniformly that the economy is slowing down, that for some consumers there are stresses. They're feeling the pressures of high prices and starting to do things that are showing that stress, which is changing the demand for a lot of baseline products. We started hearing probably 3 or 4 months ago, lower income borrowers, low income households, moving their purchases from, say, pods for washing dishwashers or the washing machine to powder or liquid, because you can ration that. You don't have to fill it all the way to the one line. You can fill it a half and then get more out of those things. And people are smart. They can figure out how to make their dollars go as far as possible. So it's all those sorts of things that are out there. And our sentiment measures from business leaders, they all tell us they do feel like things are a little slower. But slower is not necessarily the same as weak or non-existent or troubling or whatever words you want to use. And we're not hearing the extreme words. It's interesting. In the last cycle, nobody asked about the probability of recession or when a recession is likely to come. That wasn't in people's mindset today. It's a risk, and so we have to be mindful that risks are out there. But it's, in some ways, I feel like the sentiment is such that the risk of those kind of catastrophic outcomes have receded pretty significantly. And that's been an interesting shift over the last several weeks.
So risk management then, which brings us to the question of the December meeting. So as someone that's been covering the Federal Reserve for a while, usually all we get is a policy is not on a preset course. What we got on Wednesday from the Fed chair was not only that, but December is not a foregone conclusion, and then far from it. We don't usually hear that. How are you thinking about December, knowing that it's still a few weeks away, but how are you approaching that meeting?
Well, we have a lot of time between now and then, and hopefully we'll get more data. Hopefully we'll get some of the hard data, but certainly we'll be out. Our teams are already out in the district talking to businesses and trying to get a perspective on how things are evolving. The consumption data has been pretty healthy. We definitely are seeing this K-shaped or two-speed economy, however you want to think about it. And a lot of the consumption that we're seeing, a lot of that is coming from the higher income families. And that's been really sustaining the growth in GDP. And so that's something we need to watch, because we are hearing that there's a lot more pressure and a lot more pain in those lower income families, that they're just, it's interesting. You talk about kind of stretching the detergent or the washing powder. What we're hearing is even at a more affluent supermarket, they're saying that they're seeing 10 to 15% increase in promotional items. And regular items are not, they're not seeing growth in that. So you're seeing it even now starting to creep up that wealth spectrum, where I think it had been, we know that those lower income households know how to manage that. They're working hard to do that, but we're seeing that creep up a little bit. So again, this is a challenging time for monetary policy. We're gonna have to watch closely to see how things evolve. As I said, I would have preferred not to have gone at our most recent meeting, but I want to be very attentive to these announcements that are happening on the labor side. There may be something that I haven't seen in that labor picture that could be more signs of softness, and I want to be open-minded to that, because we do really need to balance both sides of our mandate. But right now, when I look at where we are on the unemployment side, we're missing our unemployment goal, maximum employment, to me by maybe a couple of tenths. And we're missing on our inflation side by a full percentage point. And I think that's going to persist for longer. And so when I weigh those two things against each other, I think we need to stay restrictive to continue to bring down inflation.
Yeah, I would say I was glad that the chair added those few words, if only because I was really concerned, and I've been concerned for a while, that a narrative would emerge that would suggest that we're on a march to somewhere, that there was an appreciation that we knew that we had a ways to go and we were just gonna go, independent of whatever information was gonna come out. And I mean, you can look at some of the market probabilities that were happening. that was suggested that they started to think things were just marching and we were just going to go there and get there. And that was not where my head was. And I thought that the chair pretty accurately reflected the range of views that are that are on the committee, and that was information that needed to be out into the public domain. I'm going to say every meeting is live. We're not on a preset course. We're going to let the information guide us. And I'm going to stop there so you can be happy.
Well, can I add one more thing to that?
Yeah,
I
please.
think the market tends to over-focus on the median from the SEP. And they take, you hear in different market commentators talking about that as a promise. It's not a promise. It's not forward guidance. It's our best view of what we think right monetary policy looks like. And in our September SEP, you saw a pretty notable difference between, there were 10 participants that thought there would be 3 cuts between September, October, and December. And then there were 9 participants that thought there would be, 2 or fewer cuts. We've already had 2 cuts now. And so if you even have one person who shifts their viewpoint, now that could shift. There's a lot of data that happens in between that September SEP and our December meeting. And so it is important to remember that we are not on a preset course. We are looking at it. And what that SEP does, if you actually look under the hood rather than just focusing on the median, there's a lot of information. It doesn't tell you who's voting and who's not voting, but it does give you a better sense of the range of viewpoints on the committee and how things may progress relative to our expectations.
Yeah, I'm just going to add that, the median is math, right? It is not a decision process. It's not a deliberation. It's not an argument. It's not any of these things. And I agree with Beth in the sense that people interpret a mathematical statistic as process, as a decision. Like when each of us puts in our dot, we have not talked to anybody else. We don't actually know what it's going to be. We find out what it is like Monday night, right just before the meeting starts. And so this is not something that reflects a decision. It's like, and I'll just say for me, my dot embodies an outlook, a narrative about where the economy is likely to go over the next 6 months, 12 months, 18 months. Each dot does that. But we have not talked about whether our outlooks are the same, what we think is going to happen, which ones are going to be more or less likely. And so that chart is a nice picture. I think one of the big values is that, just to make clear, there is a range of views of this, and that we're a deliberative body, and people are able to have their own view. But don't get too far ahead of us on this. Every meeting is live. We're going to be data dependent. We're going to do all the things that we need to make sure that the decision is appropriate at the time we have to make the decision.
And I do know this is a bank funding conference. I promise you there's a discount window question here coming in a second. But I just have to drill down on this one more time because, the SCP, we didn't even get one this week. And so, obviously we're expecting the next one next month. But this is a moment where the range of views is diverging at a level that I have not seen in a little while covering the Fed. And so, what was the tenor of, I guess, of the conversation, knowing that you have so many, in this room, we heard from President Logan earlier this morning, talking about her views on, the decision on Wednesday. We have 2 people in this room already that didn't necessarily support that quarter basis point cut. So as a journalist, right, I go on the Today Show, I go on the Nightly News, I'm trying to explain to people what's going on with interest rates and what their borrowing costs are going to be. Market participants are watching, people playing Fed funds futures. They're all trying to figure this out right now. So where do we go from here? What is to be taken from the mixed messaging that seems to be a risk with all these diverging viewpoints?
I think you're hearing differing viewpoints because we want to make sure that we're doing our best for the American public, and it's not clear what the right answer is. And so what we have in the room is you have 19 participants who come in from very different backgrounds, very different sets of experiences, very different perspectives, and it's actually a really robust conversation. It was one of the things I found that was surprising to me. I've only been in the job for 15 months, but walking into that room, the level of care and thoughtfulness that each person brings to their commentary and how everyone listens so carefully to one another. You see people in the room changing and adapting their viewpoints and thinking about things differently. And it's a really collegial environment. I really go in there And I will say, I probably learn more from the people who see things very differently from me and who end up on different sides of things, and I really value those perspectives because it challenges me and helps me think about what am I missing? How can I make sure that I'm doing my best to deliver on our mandate?
I agree with that completely. It's a wonderful collection of people that I have the privilege of working with. I will also say, like in my 8.5 years of doing this job, this is the most difficult time to make a forecast. There are so many things that are moving and so many things that are changing. If you had 8 dimensions and there was a yes, no on 8 of them, for us not to be having different views, you'd have to have us all make the same decision about where we are on all those dimensions. And that is just not a likely thing to happen. So I think that the diversity is actually a positive reflection of the times that we are in. And the most important thing that I hope for and I'm seeing is that everyone is doing their honest best work. They're trying to do their best to discern what it is. And we may have different interpretations. You know, you talk about the cyclical versus the structural and labor markets. Some people think that it's mainly cyclical. Others might think it's mainly structural. You're going to wind up in different places naturally. The question about tariffs that you asked, are we through with the impact of tariffs on prices, or is it still some to come? People have genuine and legitimately different views on that. This is why trying to get data and have the data inform can actually help us come to a closer appreciation and agreement on where the world is, so that we can coalesce around an appropriate path for policy. And that's really going to be our task. It's always our task. We're going to have to double down on it over the next several weeks.
And can I just say, I think this is where our staff come in, and I just want to give a huge shout out to our staff, both at the reserve banks, but at the Board of Governors as well. They do an amazing job in sifting through a tremendous amount of data, running different scenarios, running different alternative simulations so that we can have a broad perspective of not just what a base case is, but what a risk management case would mean. And this is why we have research economists that help us think theoretically, big picture, long term, around how the economy might perform in different scenarios, might respond to different shocks. And that helps us to learn a lot so that we can hopefully do our best job.
Okay, so the bridge that I am now going to cross to go into bank funding is the balance sheet, where we also got the announcement this week that the runoff would be ending December 1. Walk us through the thinking on that, and what were you seeing in short-term funding markets that told you this was the time to do this?
So we've seen some pressure recently in repo funding markets. And so our target is the Fed funds rate. But the Fed funds market is a pretty small market relative to money markets broadly. And so the Fed funds market is about $100 billion. Repo markets broadly are more like $4 trillion. And so we have to look at a constellation of those things when we're thinking about how the balance sheet is performing. My viewpoint is that we are in an ample reserves regime. I think that's the appropriate regime for us to be operating in. I think it provides a low cost of reserves to the banking system. I think that's efficient for us to do as a central bank, to provide those reserves to the banking system. And what I want to see, like President Logan articulated in her speech, is that I want to see repo rates and money market rates trading roughly in line on average with IORB. And so what we've seen more recently is that as we've been running down our balance sheet, as we've been letting the roll-off happen, we've started to see more episodic movements. And so there are times when we're running at that level where TGCR is running in line with IORB, but then you have moments like today where there are big settlements in coupons, 58 billion of coupon settlements today, plus you have Canadian year-end, and you see more elevated pressure. And so we have tools that are set up to deal with that. Both the standing repo facility and the discount window would be another borrowing tool that banks could avail themselves of. Those are set at the top of the range. But it looks like a leaky ceiling. I don't know if you can call it a leaky ceiling, but it looks like some things, I don't know, the balloons are floating away when banks aren't participating and taking advantage of those tools that we have, like the standing repo facility, for them to be able to monetize it. And to me, the standing repo facility is just a way for us to implement monetary policy and for us to have effective rate control. Because even though our directive is in Fed funds, I agree with Lori that the market has shifted. The market has shifted quite dramatically since Fed funds was our primary tool, and
Maybe
I think
time for a
it's,
new measuring
I
stick?
think it's time for us to look more broadly, because we have very effective control over a $100 billion market. But the market is 4 trillion, and so you've got 3.9 trillion that's happening over here. We've got to be able to have some amount of control over there to be implementing effective monetary policy.
If you'd like to chime in on the Fed balance sheet.
very-
And then also tri-party.
Very little to chime in on. Beth has been working on this a long time. I will say, for me, I think we have, it's in our interest to limit the amount of volatility you get in terms of the functioning of these markets. And those spikes that we've been seeing in the last several days suggest that we're already seeing volatility. Going any appreciably lower than where we are now is just going to add to that and lead to disruptions and lead to having to do more continuous interventions in a way that is not really, I think, where we want to be. So I'm very comfortable with this, and I think for us the next steps are going to be how do we navigate as the economy continues to grow, as these markets evolve, so that we are always positioning our balance sheet so that there is stability in the functioning. And those will be conversations that happen over the next several weeks.
Okay, so my question now that, I guess RIP QT for at least for this round, but is it mission accomplished on funding markets? Because obviously you have lots of flashbacks of the 2019 repo crisis. There are certainly concerns that, all right, well, if things flare up again, would you then have to potentially go back in and start buying assets again? Is that something that?
I mean, our balance sheet is a living, breathing thing, and it's not, there are elements of it that are within our control, and there are other elements where the subcomponents shift around for factors other than things that the New York desk is doing to help maintain control. So when Treasury's general account increases materially, that mechanically takes reserves out of the system. And so what we need to make sure that the ample reserve regime is working is we need to have good visibility as to what some of those fluctuations are going to be. And that's a very difficult thing to project. It's very difficult to know exactly how those changes are going to happen. Our goal was to end runoff at a point when we were just above ample so that we'd have some time to see how things were moving, and then could evaluate when the right moment was that we would want to grow reserves further. I think there's benefit for us in having the smallest possible balance sheet that we can while operating in that ample reserves framework, but it requires not just us watching the markets and understanding what that growth in reserves and currency is going to be. It also requires the primary dealers to help transmit and redistribute reserves throughout the system in an efficient fashion. That's what I think is one of the key roles of the primary dealers. And so it is disappointing when we put tools out there, tools that I might say they actually had requested. I think primary dealers were one of the key groups that suggested having a standing repo facility would help eliminate issues like we had in September of 2019. And so we've put that tool out there. It's available for them. I'd like to see them take advantage of it to help redistribute reserves throughout the system.
So you're a little more in we can run this in a very efficient way. I'd like a little extra buffer, because I do think because the balance sheet is so dynamic, it is organic, and the world has become sort of more uncertain, the swings that might occur could be outsized relative to our experience. And so having that extra buffer, I think, gives us even more space to ensure that these facilities can provide the amount of liquidity that we will need at the point in time. The thing I do worry about is the facility may have a certain capacity they can serve, and we get some outsized unexpected shift, or 2 or 3 things move at the same time, we find we need more than that and are not positioned to handle that. So for me, I'd like to see more in the buffer, but the point, I mean, we probably should do an explainer on how the balance sheet evolves over time in ways that allows people to understand the dynamism that actually exists in it, because it is quite complex.
It'd be hard for me to convince the Today Show to want to do something on that, but maybe we can try.
I mean, the makeup of the balance sheet is not a sexy topic for mainstream America. I'm shocked.
I'll run it by Savannah Guthrie and see if we can make something happen. But this gets in an interesting point, which is that, semantically, there's a difference between how people assess the line of ample to abundant, right? And so I guess since even there seems to be here a little bit of different views on that, how do you think, where's the difference coming from? Is it also regulation, knowing that, you know, if there are more stringent requirements that are requiring banks to hold on to liquidity, that requires there just to be, by sheer aggregate numbers, more in the system?
I don't know that we differ necessarily on how we determine ample versus abundant. I think it's maybe just our preference of how important is it to be just at ample versus abundant. I think Raphael is saying that he's okay if we're a little bit closer to abundant. I'm saying I'd prefer to stay just at ample. The way I judge it is the same way that Lori judges it, which is that is TGCR averaging generally where IORB is. That to me tells us that we're in that efficient, ample moment.
Let's go. I'm team abundant. I'll just say that. That's what we should get.
And I do want to remind the crowd that in a few minutes, we're going to open it up for some questions and answers. So if you want to kind of cook up some questions, feel free to do so. We'll have the mic floating around. But you mentioned tools, Beth, the discount window. So, you know, there used to be a stigma. It was a bad market signal to have to tap the discount window. We saw during 2020, there was kind of a change in terms of trying to encourage banks to do so. There are obviously a large number of large banks in both of your districts. What does that conversation look like in terms of getting around that stigma? How should banks in 2025 be thinking about the discount window as an available tool?
So we have been working with the banks to help them understand that it is a tool that's there, that's meant for them to use if they need it. I don't think of it as a regular way funding tool. I don't think of it as sort of their first port of call. But if they're in a situation where they need to get more liquidity, and it will help provide that bridge for them to give them the liquidity they need to make it to be able to get into longer term funding options, that's what it's there for. And so we've been encouraging banks to think about, does it make sense for them? And if it does make sense for them, if it's part of their liquidity planning, their contingency planning, that they should test it out, they should position collateral, they should think about using it from time to time so that the first time you're using it is not in the middle of the stress, right? The reason that you run fire drills is because you want to know how you get out of the building in a fire before the fire has actually happened. And so I would say that the preparedness around the discount window is the same thing. We've seen really good progress, I'd say, within the 4th District in terms of banks moving to a place where they are ready to use it. It doesn't make sense for necessarily every financial institution. We've got over 200 financial institutions in the district. Some are very small. And for them to pre-position collateral just doesn't make sense because they'd rather not have it encumbered with us. They'd rather have the flexibility to do other things with it. And that's just fine. We just encourage people who do think of it as a tool that they want to use to be ready to use it. And I think we've been spending time as a system to look at how can we improve the discount window? How can we improve the ease of use and simplify it so that banks feel like they have the ability to take advantage of it if they need it?
Yeah, I think there are at least two aspects to this. One is what Beth was talking about, which is preparedness. And on some level, it's human nature to, as you get further away from a crisis, to think that you don't need as much insurance and coverage and protection and preparation. So, you know, I lived in California for many, many years. The moment when earthquake insurance is at its highest is like 2 days after the earthquake. And from that point forward, people start dropping off as you get further and further away. So this beating the drum of it's here, you need to know how to use it, you need to make sure that you have people in the building who can do these things is quite important, because we know at the last crisis in Silicon Valley Bank and other institutions, they were not ready to use a tool that could have provided some help. And we want to make sure that that problem is not the problem. There may be other problems, but I don't want that one to be the problem. And the second thing that we've heard a lot is that the interfaces have been clunky. They're not user-friendly, and that can be a disincentive. So, you know, we all, like, I was actually just on a chat line trying to manage some things, and, you know, I typed in my question and it answered a different question. And if you start having those experiences, there's a natural impulse to just shut the whole thing down and just forget it, and I'll just not have to deal with it. And I don't want that to be a problem either. So we need to make sure, and there's been a lot of progress on this. You heard a bit about this with Discount Window Direct and other things. I hope for the bankers here, you're all using this and tapping into it. And please give us feedback. So if there are things that you think would be helpful, so we can continue to work on these things. But I think it's important for us as a system to make these tools as easily to use so that when things happen, the help that is available can actually be used. Because that would be the tragedy, that that there was help there that could have made a difference, and it didn't make a difference for readiness reasons. That would be a shame.
I want to ask about stable coins. The pressures in money markets in 2020 2020 obviously was crazy on many fronts, but that was a particularly interesting point because a lot of these prime funds had these huge outflows as a result of what was going on in crypto, what was happening in stable coins. Is that a risk to bank funding as well? And is there a solution to that? I mean, there's been some suggestion that maybe some Fed tool should be made available to some of these stable coins. Like, is that a thing that you think about?
I mean, stable coins is an exciting emerging technology, and I think time will tell what the use cases are going to be. I do feel like, we hear from the banks and we hear from individuals that there is demand for being able to move money faster, and that's something that we need to be able to do. We put in place FedNow to help facilitate that, but I recognize that is still an alternate payment rail, and it's not, it lives in a different ecosystem than some of the crypto and stablecoin universe. And so I think that there's a lot of opportunity, and I think there's a lot of experimentation that's currently happening. And we're going to learn a lot over the next couple of years just in how these technologies evolve, what those use cases look like. And I want to hear from the banks, and I want to hear from businesses and individuals about where their priorities and preferences are, because it does shift over time. One of our core functions at the Fed is to help run the nation's payment system. And so we do need to be attentive to how changes are happening and make sure that we can provide good, low-cost options for banks and individuals to move money where they need to, when they need to.
So when it comes to stablecoin, I think the biggest question is which use cases will emerge and which ones will become dominant. So one that I think there's been broad consensus that stablecoin will be helpful in is in cross-border payments. Pretty much everybody understands how that works and why there are going to be advantages to that moving forward. Other than that, I talked to 10 different people. They have 30 different use cases that are possible, and none of them are confident that any of those 30 are going to be the one that becomes the dominant case. So I think we're still in the early days of how this will manifest itself into the payment system, and also what the implications are for banking institutions and the banking sector. There are some use cases that could actually be disintermediating, and others could be kind of reinforcing and complementary to a lot of the services they're providing. And right now, I don't have a sense of which ones are more likely or how this is going to play out. And a lot of the legislation that has been passed and that is moving forward, in those things, there are still open questions as to how things would play out. So a lot of this will depend on how those questions get answered as to which things are going to be, or which use cases are going to be the ones that we'll have to have a deeper understanding of, to then figure out what the Fed's role might be in facilitating a payment system that works well.
And then I want to ask about just something that a lot of bankers are thinking about right now, which is some of these bad loans. JP Morgan CEO Jamie Dimon describing it as cockroaches that are floating around. I mean, at best, I guess it's a bank that maybe got fooled by a company that's doing fraud. You take a larger allowance, it's not a big deal. The other side of things, is that something that could start another SVB moment? That's something that people are worried about as well. Are you seeing any signs of that in your districts? Is that a worry when it comes to bank stability on a bigger picture?
Yeah, so we're not. So one, we get paid to worry, right? So we're worrying all the time. And these are things that are sources of concerns. But I will say, I'm not hearing this among the banking institutions that we engage with, that this is an issue. Fraud is an issue, period. And it's been a big issue in the banking sector, as many of you know, for quite a while. And it's been the simple stuff that has been problematic, not the high-tech, sophisticated things. And so thinking about how we create a system that allows us to minimize the amount of fraud is something that we all have to worry about. One area where I do get a little more worried in this regard is that for many of these institutions, they're tied into non-bank sector and non-bank financial institutions where we have less clear and less transparent sight lines. So having a sense of where there are potential spillovers in that context actually is a concern, and it's a question that we will have to investigate a lot more deeply. Today, though, I'm not hearing anything that suggests that this is spilling over into sectors such that we might have systemic issues.
Yeah, it's been a long time since we've seen a proper credit cycle and since we've seen proper defaults. And so it's a good reminder that as you get later and later into a credit cycle, you do tend to see sometimes supervisory practices, compliance practices start to break down a little bit. And so it is healthy, I think, to see some of these episodes and to make sure that individual banks are going through their lending books, they're making sure they're doing the diligence, they're doing the compliance, they're checking to make sure things are there. I think the banking system is in very good shape right now, broadly, and the capital levels are healthy. And so I think the banking system is in a position that it could withstand some amount of a default cycle. That's not my base case, and that's not what I'm expecting or hoping for. But if we did see some more of this happen, I think the banking system's in a good position for it. So I'm not worried about an SVB type situation on the back of it. I do think there has been growth in non-bank lending, and then banks coming back and lending to some of those non-bank institutions. And that's something, because as Raphael points out, it is opaque. It's hard for us to get our hands around what the sizes are, making sure we understand all that interconnectedness and what the ramifications, if there were to be a bigger default cycle, what that would mean, I think is something we need to spend time looking at and thinking about.
Great, well, let's open it up to questions now. We've got about 15 minutes. So I think there's a question right there in the back. And if you could just introduce yourself and ask your question.
Hi, how's it going? My name's Paul Egge. I am a banker at Texas Bank, Stellar Bank. The one aspect of the landscape of bank funding that has not been prominently addressed here is the tremendous shift in deposit market share post-Dodd-Frank towards the too big to fail banks, worsened, of course, by the liquidity crisis, and the potential downstream impacts this has on industry structure, really. The playing field for deposits, capital, and financial performance is tilted towards scale, largely thanks to the consequences of legislation, but regulatory structure plays a part too. What are your thoughts on these dynamics, and what can be done to improve the overall value proposition of smaller community banks that are vital towards lending at a local level?
So I agree, having a strong community and regional banking system is really important. I think one of the reasons why the US tends to outperform in small business growth is because of that community bank lending that happens. It's that Main Street relationship. I see it when I'm traveling out in small towns like Worcester, Ohio, where you see the local banker who knows the wedding dress store owner, and they build that relationship, and he's monitoring her business, he's understanding, he gave her that first loan, and he's helping her to think about what's the right time to expand and how to grow that business. And so there's a lot of, I think, really good economic growth that happens in this country because of those small banks that we have. And deposits are a critical part of it. And so there have been some newer strategies to help mitigate that and to expand the deposit insurance, like reciprocal deposits. That's a tool, like many other tools, that can be used. But I think, an alternative proposal could be expanding deposit insurance. That's not within the Fed's remit, but I do think some of those strategies might help to mitigate some of the imbalance that we see where, in stress, you actually see inflows into the largest banks and out of the smaller banks. And I think that's something that, we need to continue to monitor. Some of the tools we have, like the discount window, are there to help to bridge if some of those liquidity movements are shifting in acute ways, but supporting community banks and ensuring that they have every ability to compete with the larger banks, I think, is critical. You get a different value proposition from banking with a community bank versus banking with a large bank. You get a different level of service, a different level of connectivity. That's what I hear from the bankers on my board and in my district, is that's the reason that they're there, and that their clients will continue to work with them. But I do feel like it is in our interest, both as a Federal Reserve, but also as a country, to help make sure that those small community banks are able to continue to thrive and provide credit to these local small businesses and smaller institutions.
Yeah, so Mike Johnson was on the stage here yesterday interviewing Randy Quarles. Mike was the head of supervision when I started in Atlanta. We wrote a piece maybe 6 years ago about the importance of community banks and how we needed to make sure that market structure and industry structure didn't evolve in ways that put them at a competitive disadvantage. And some of it could be regulatory, and I know there are going to be a lot of proposals in that. Some of it could be industry structure. So it may be that the community banks build a consortium that allows them to have sophisticated interfaces that approximate or can compete with what the big banks can do. Because the big banks have resources to build those sort of things in ways that community banks do not. And I think this has got to be an all of the above proposition, because across my district, I got Florida, Georgia, Alabama, Mississippi, Louisiana, and Tennessee. There's a lot of small town in that. And there are a lot of community banks that are serving the vast geography that I'm responsible for. And when I go to those towns, they are all worried that they're being forgotten, they're not being seen, they're not being served. And community banks are built to do all of those things. And so we need them to be strong, and we need to continue a conversation that allows them to have opportunities to tell us the things that need to come together so they can thrive. Because when they thrive, we come closer to having an economy that works for everyone, so that particular communities are not left behind, they're not forgotten, and the smart people, the enterprising people, the ambitious people in those communities believe they actually have a shot to do the things that allow them to be great. And we should be trying to support that as much as possible.
Next question. I think right here.
Hello, I appreciate your comments this morning. We've heard some comments about stable coins, which is primarily a private sector initiative at this point. About 2 years ago, the Fed put out a request for comment on the potential for creating a U.S. Digital currency. And I'm curious as to where the Fed is currently in its thinking about moving forward with that development.
I don't think we're anywhere.
I think there was an executive order that explicitly outlawed a U.S. central bank coin.
Yeah, so that's not happening right now.
But there's been a lot of work that was done studying the technology to understand how the payment system is shifting. And it's really informed a lot of our thinking around stablecoins and around what the use cases are and how we can modernize the payment system, how it would interact with FedNow, which is our real-time payment service. And so I think there's a lot of good things that came from that analysis and that viewpoint, but we have a narrow mandate and we're going to execute what Congress wants us to do. And Congress has told us and the president has said that they don't want us to put a central bank digital currency out there, and so that's not going to happen.
Next question. If not, I'm going to have to ask about like Halloween plans. I think there's one back there.
I know Brian already asked about the discount window, and I just want to circle back to that a little bit. Given the discount window is generally used as a backstop during periods of funding stress, how do you assess its current effectiveness of supporting liquidity without signaling weakness? Should the discount window be repositioned as a more active liquidity tool rather than a method of last resort? It's cheaper, it's faster, money can get to banks quicker. If so, what changes do you feel like need to be made in order to make that shift effective?
So I think this raises the question of how do you want to position these tools? I see the discount window as a tool that should be there for banks to take advantage of if they need it, but it's not a regular way funding source. And so that makes it a tricky thing to balance, right? You want banks to use it when they need it, but the fact that they need it then indicates, well, maybe something's not exactly right. Now, that not exactly right doesn't have to mean that there's an existential stress that's happening. It could just be there's timing mismatches. It could be that there's a better opportunity and you can lean on that discount window liquidity so that you can continue furnishing loans to your client base, which I think is an important function for the banks to play in any part of the economy. But how you calibrate that, I think, is a tricky choice. And so I do feel like having it priced at the top of our band, a primary credit rate there, is the right place to do it. We should lend against good collateral. We are happy to continue to provide that funding to banks to ensure that credit is flowing through the economy. But I don't think it's meant to be a bank's first choice funding tool. It's meant to be, I think, a backup for when your normal way planning goes awry. I think we heard yesterday on the panel that one of the most important disciplines in managing liquidity at an institution, and I say this with some confidence, having done that myself in my prior life, is maintaining diversity of funding sources. You want to make sure that you have as broad a range of sources available to you so that you can lean in different dimensions, because you never know what's going to happen in different markets or in different segments. And so having robust deposits from your clients, having brokered deposits available, potentially reciprocal deposits, accessing term debt funding markets, maybe CDs, and the discount window is another component of that. The home loan bank system is another component of that. There are a lot of different sources out there, but making sure as an institution that you are using all of those, that you're testing them, that you're continuing to participate, will make sure that you have that diversification of funding, which I think will ultimately strengthen your funding tools for the long term.
So you highlighted something, everything she said is exactly right. But you highlighted something that's actually a tension with the discount window, in that we do want people to use it, but we don't want people to use it and crowd out other sources and vehicles for getting liquidity. And how you communicate that, and how you talk about that, and how you articulate what the line is that is appropriate is very difficult in a large and dynamic economy. And that's one of the challenges I think we've had institutionally in articulating sort of what the appropriate use for this is. And then I think it's also been hard because the interpreters have an ability to make their own judgment. Like, we may say one thing and they may just take it another way. And so there's implicit risk that I think institutions have been facing that has been a challenge. And when I started here in 2017, we were on a task force to try to reduce stigma in the discount window. That task force is still working, right? Like, we haven't found the answers to this, because I think this is actually a very complex problem that has some technical issues, but there's also a lot of psychology in it that requires sort of working through and trying to find a sweet spot that may or may not exist. And I think that's the effort.
I think we can squeeze one more question right up here. So maybe a discount window rebrand, like the super fun funding
The purple
window.
pandas window?
Yeah, there you go. One final question.
I think it was a tie for us to raise our hands. So I'll be quick.
Okay.
But I'm just curious how quickly you feel that you can implement an operation if you feel that you've withdrawn too many reserves. And in what order do you think that you would do that, whether it's an IORB cut, TOMOS, POMOS?
So that's a great question for the New York desk, who runs the open market operations. They do give us briefings at the FOMC meeting every time we get together, and they're very collaborative and share insights regularly about what's going on. I have every confidence that they are prepared to make sure that the system is filled with the ample level of reserves as they have been directed by the FOMC, and that they will continue to support healthy market functioning in funding markets.
Okay, any final thoughts on anything from either of you before we wrap up?
Well, thank you for being here and doing this. It's been great having you with us. Thank all of you for being here. These conferences only work if people show up and people have thoughts and are willing to share them in an open and collegial way. And I think this has been a fantastic experience, fantastic time, and I've learned a lot of stuff. So thank you.
+1 to all of that. No, this was great, and really, it's such a pleasure to work with Lori and Raphael and all of their teams to help bring this together. And hopefully, we'll do these again. I think it's a really good convening. I love when we get the perspectives of academics and practitioners and policymakers all together, I think there's a lot of learning that happens, and it's really where we help to push forward on. So thank you, and thank you for being here, Brian.
Thanks for having me. Well, thanks so much for that wonderful conversation. I think I'm tossing it back to Mark, right?
Well, thank you, Raphael, Beth, and Brian for a great concluding session. Before we break up, I just would like to extend a special thanks to Mark Jensen in Atlanta, Paola Bowl in Cleveland, and Alessio Soretto in Dallas for putting the meat of this program together. And a double special thanks to all of the people who work behind the scenes on the logistics, the AV, the catering, all that stuff, without which these events just don't go well. There are box lunches available outside. And with that, we are concluded until next year. Thank you all.